Number one, we have a lot of clarity around interest rates and the Federal Reserve that came out of a talk that Scott Bessent gave. The fear out there is that we are selecting a new Fed chair, as we do every 4 years, in May of 2026, and that Donald Trump is exerting too much control over the Fed. We'll talk about that. Secondly, the AI bubble. We're in a bubble. We're in a bubble. We're in a bubble. We heard that so much at the end of last year. I hope to show you that the bubble has popped and it's time to reload your AI allocations. Private credit also had a very tough end of 2025. A famous Wall Street CEO said there was a cockroach in the private credit markets. And I think that those fears are overdone, but well priced, and again, an opportunity.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today we've got the great fortune of having the return appearance of one of the most respected capital allocators in the business, Jan vanEck. Jan is CEO of vanEck, an asset management firm with over $100 billion in assets under management invested across its wide family of ETFs and funds, spanning equity, bond, commodity, digital, and regional asset classes. As we've done over the past several quarters now, Jan and I will spend the next hour discussing his Q1 macro and market outlooks, as well as where he sees the biggest opportunities for investors right now. Jan, thanks so much for joining us today.
Great to see you. Happy New Year.
Thanks. Happy New Year to you as well. You look great. I understand you were just in the sun up until yesterday. I hope you had a fantastic winter holiday with your family.
It was restful. Thank you. Yep.
All right, good. Well, Jan, look, we've kind of done this drill enough recently that the audience is probably just saying, Adam, stop talking and just let him get to his slides. So I guess let's go straight to them. But I guess before you pull them up, if you had to just sort of highlight a central theme or maybe even a central word or phrase for 2026, what comes to mind?
Yeah, visibility, I guess, which means risk on. I mean, that's the title. So maybe I should just say risk on.
All right.
If you want one phrase.
Okay. Well, that's very optimistic and exciting. So I think folks are going to be really interested to hear where you see the opportunities in a risk on year.
Yeah. All right. Well, before I get into it, just if you haven't heard this quarterly outlook before, as Adam mentioned, I am CEO, but I also sit on vanEck's investment committee. And what we try to do in these quarterly outlooks, I see a lot of charts, and my 52 investment colleagues at vanEck see a lot of charts every day. And what I try to do is, in this quarterly outlook, emphasize what might be missing if you're just tuning into a lot of the financial noise that comes out of the markets. So, so I try to pick charts, hopefully that maybe you haven't seen before, or a little bit more interesting and relevant. So that's the hope.
Well, you always do a great job with that, Jan. I'm sure it's going to be no different this time.
Well, so thank you. Starting it off, just besides the fact that we try to make these charts interesting, our perspective is very much that the financial markets sit within a world that is changing very quickly because of political events or economic changes or technology. And so we think those forces can pull the market in ways that you might not fully appreciate if you just stare at market prices themselves. So that's our perspective. It's also, if you want to say there's an inefficiency that we try to take advantage of, it's having a longer time perspective. So that time perspective means actually changes can happen very quickly, but sometimes you can feel more conviction about something that's going to happen in 2030 or 2035 than what everyone else is trying to do, which is, say what's going to happen in 2026. Mm-hmm. So you can decide at the end of this whether the experiment is worth it. So from the perspective of 2035, there are these big magnets, I call, pulling at the financial markets. One is this huge fiscal deficit that we had. It was the worst ever in peacetime. How do we stand relative to that? Again, to my theme of the day, we have greater visibility and better situation in fiscal situation. So we'll get into that. Artificial intelligence, the token demand that's out there, we spent a lot of time talking about last quarter, continues to be extremely strong as reflected in the Mag 7 earnings. India is still growing. I won't spend a lot of time on that. And we had a lot of financial innovation last year. What does that mean coming into today and the themes that I'm going to talk about today? Number one, we have a lot of clarity around interest rates and the Federal Reserve that came out of a talk that Scott Bessent gave. The fear out there is that we are selecting a new Fed chair, as we do every 4 years, in May of 2026, and that Donald Trump is exerting too much control over the Fed. I will talk about that. Secondly, the AI bubble. We're in a bubble. We're in a bubble. We're in a bubble. We heard that so much at the end of last year. I hope to show you that the bubble has popped and it's time to reload your AI allocations. Private credit also had a very tough end of 2025. A famous Wall Street CEO said there was a cockroach in the private credit markets. And I think that those fears are overdone, but well priced, and again, an opportunity. I asked the question, investors say, did I miss gold? And the reason for inaction is a very simple, yes, I feel like I missed gold. So we'll talk about that, and then a little bit about what else to buy at the end. I love to pick on stuff that's so hated and feared and where we see opportunity. Okay, so Scott Bessent snuck in an interview, a podcast interview, the last week of 2025 that is so profound. I actually listened to it 3 times.
Wow.
And there are just a ton of takeaways that I tried to summarize on this slide. So first of all, he articulated a very thoughtful, academically supported view that the Fed should be much more restrained, that the amount of QE after COVID was excessive. He calls it a gain of function Fed in an October article. And he said, basically, his philosophy that he was selling is whoever the chair is, these are Jan's interpretation, not his words, is it doesn't matter because there's no way we are going to nominate a Fed chair that's going to be as active as the Fed was during Biden. And he's very clearly, his critique, although he doesn't name names, is that the excessive QE of the Fed caused 10% inflation, which Americans are very upset about and continue to be upset about. And that's what he's fighting, and he blames basically the Fed for that.
All right, so sorry to interject, but just for the few folks that might not know, Secretary of Treasury Scott Bessent is leading the Fed chair selection process for Trump.
Great point, right? He's at the table, right, and defining this. And importantly, the Fed chair nominee from the Trump administration needs to be approved by the Senate. So I really feel like he was speaking to the Senate here, Adam, and trying to lay the groundwork. So my basic point is, I think that he is doing such a good job at this that we know that it will be smooth. There will be people are worried about Fed independence. I don't think that's what's going to end up happening. They'll pick a nominee. The Senate will approve the nominee. The second point here, though, that's probably surprising if you listen to Donald Trump last year is Scott Bessent said that interest rates are at normal levels. Now, he didn't nuance it short-term versus long-term. But can you imagine, like, that is such a sales pitch, right? To people that are afraid that they're going to cut short-term interest rates, from 3% to 1%, like Donald Trump might say that he wants, so that the market's expectations to me of 25 to 50 basis points or a quarter or to 0.5% at the short term seem very reasonable. So I would be surprised to be surprised here by monetary or fiscal policy. He also does talk about housing, to the third point, explicitly as something that was pumped up by the Fed. Asset price inflation, stock prices being up, and that those are the enemy, and the Fed should not be in the business of pumping up asset prices. And then lastly, if inflation gets below 2%, he basically said we shouldn't have an inflation target anymore at the Fed of which is 2%. He said, make it a range. He said the markets are way too complicated. It's much more like biology than math. So I would, again, we should not be surprised if inflation continues to trend down, that the Fed will change this kind of philosophy. So I feel like really clear monetary policy, not a big change, no surprises. Maybe they cut a little bit. It's basically what happened last year. It just felt much more dramatic.
Okay. Can I ask 2 quick questions?
Of course. Yeah, let's go.
So given this, is your expectation that the Fed's reaction function will be slower in the future to economic weakness or market instability?
No, he made it very clear. He liked the central banks that got involved post-COVID, but he specifically mentioned that he liked them to be involved for 2 or 3 months, not 2 or 3 years.
Okay, so still swift action, but just less of the action.
Correct, and much less longer. Like, don't try to manipulate the financial markets. Like, we were buying housing bonds 2 years, and the housing prices were setting all-time records. Right? It was like, no more of that.
Okay, got that. And then from an inflation standpoint, do you expect 2026 then to be a year of disinflation, of continued falling CPI?
All right, we'll get there.
Okay.
All right, so really just 1 or 2 slides on fiscal government spending. Just to highlight, it's a different chart, our US budget deficit versus Germany's. So this is how much the government is spending relative to GDP. It should be no more than 3%. We got to over 10% in COVID. This is what Besant's talking about. And even a couple of years later, our fiscal deficit was way, way worse. I've updated my little Jan math for the federal budget deficit. And I disagree. Like, what I'm saying is very different than what other people are saying. We are now in fiscal 2026, and I'm predicting 5.5% or less. And I can't tell you how many. There's not many Wall Street economists that agree with this, but we snuck in last year's fiscal deficit below 6%, which no one was predicting.
Yep.
So we'll see. This is controversial, but I think this sets the floor for kind of a calmer monetary policy as well.
Okay, and this is quite consistent, I believe, with what Secretary Besant has been trying to guide people to.
Yeah, I mean, this is his sales pitch for sure. But, so far the numbers have tracked. And if I maybe just highlight one thing that I did here, GDP was at 4% in the third quarter. That was a big surprise. And one of the things that Besant said is Wall Street is getting this wrong. And I haven't seen one Wall Street prediction of growth much above 2% for next year. He's saying you guys are an order of magnitude wrong. The reason I bring this up here is that if that GDP number is higher, then the percent of GDP number will be even lower. So I kind of cheated and made GDP growth for this next year at 4%. And so that's why we're at 5.3% budget deficit. But the main point is we're trending the right way. If, from what we know now, again, let's not talk about tariffs on this Zoom. We know there's risks. Well, you can ask, but we know.
I was just going to ask how much, if you know off the top of your head, did you put in for tariff revenues?
I didn't change them. And Besant talked about tariffs, and he said he was at that Supreme Court hearing, and we shouldn't think of the outcome, which I totally agree, as 100% approval of Trump tariffs or 0%, like 100% rejection. It's going to be somewhere in there, and I feel like I would just be surprised if the court were to really change the revenue figures here.
Okay.
But there's always risks to my outlook. So let me talk about the report card for fiscal, because short-term interest rates are set by the Fed, but long-term interest rates are what the market is looking at. And again, I think what this shows is we're in a troubled world, actually, but the US did okay. So let me interpret. The US's 10-year interest rates, and I know it's not 10-year, it's not 30-year, I'll show you that in a second, showed a better fiscal situation. The fact that 10-year interest rates went from 4.8% down all the way to 4 last year reflected this better fiscal situation. In contrast, other developed markets here, Japan and the UK, are having quasi mini crises, right? So the Japanese 30-year interest rates are in green at the bottom. That interest rates going up is not good when you have a lot of debt. And so countries—
it's gone up by, it's like quintupled or more since 2022.
Yeah, I mean, they tried to control interest rates. They're getting into this vicious cycle where you can't get out of. And that's really what I was worried about. And that's why I'm talking about in this outlook. It's the biggest risk to the markets is from the government spending and deficits this time around, not households, not corporations. And so it's just something to keep an eye on. But that's why I think we have visibility and a good outlook. This is just the 30 years. So the same thing for the UK and Japan. You can see we did sideways. So the markets aren't totally giving us a break yet. So it's still a risk to be managed, would be my interpretation of this.
Can I ask a quick question here?
Yeah.
So I remember interviewing people in 2022 who were saying, look, there's no way that interest rates in the US are going to go above 3 because the economy is going to crater under that. That's been disproven. So, with a 10-year, US 10-year around 4-ish or so, do you think the US economy can sustain at interest rates at that level?
Yeah, of course.
Okay.
And I violated my own rules. So thank you for not calling me out. I love multi-decade charts. And so if you took this chart back multi-decades, 4% on the 10-year is not abnormal at all. It was that very, very odd period of the teens past the financial crisis that puts everything in a bad, in a wrong perspective.
That were aberrant. Yeah. Now, of course, the people were saying, well, it's different this time because we have a lot more debt and we can't handle, 3 or more. Now, again, the economy seems to be doing quite, fine. How about Japan? Can Japan sustain at bond yields like this, given its level of indebtedness?
I mean, it's really hurting its currency, and I think that is why we're keeping an eye out for it, Adam. Now, people have literally spent our entire careers calling for the end of Japan, right, and the end of the Japanese bond market, and that's a little bit why I'm highlighting it now, because it actually is really under stress, given its history. So I can't really time a crisis there because everyone who's done it for the last 25 years is out of a job,
yep,
or broke or both. So I'm just going to pass on that. I know that's a cop out, but it's something to watch.
Okay.
All right. So let's just hit some other macro concerns that people have. First of all, inflation. And as you can see here, we got great news on services inflation. So this is a little bit of an odd chart because it's only the prior change over the last 12 months, but it's really, really good that services inflation is coming down here. Goods went up a lot, then went down a lot. So the fact that it's going up is kind of like a reaction to just the shape of the curve. So listen, I think inflation is well behaved. Let me talk about—
Can I ask you a question on this chart?
Yeah.
First off, do you know off the top of your head, in terms of the US economy, what the percentage of services is versus goods?
Well, we're mainly a services economy. And the reason I got it right, I mean, manufacturing and agriculture are a teeny part. We're a consumer economy. The reason I focused on this so much over the last couple of years is sort of once people get, it's one thing for the price of coffee to go up and down, the price of meat to go up and down. I think what's really dangerous is wage mentality starts going like, wait a minute, my cost of living is this, so I need a 5% raise, and that
Right.
5% raise trickles through to all the other industries. And so that is the psychology, I think, that's a little bit harder to break.
Yeah.
But it's
But
big and important from that perspective as well.
okay. But on a marginal basis per equal unit, uh, falling services inflation likely outweighs rising goods inflation because services are such a bigger percentage of the economy.
If you're a Wall Street investor or an economist, but voters,
Yes.
if you allow me to go forward, are not Wall Street economists. And so they are very worried about inflation still, according to the polls. And this is just one thing on electricity costs. I really want to use this as an excuse to talk about the 2026 midterms. Again, we have visibility. Even if the Democrats sweep, it's very unlikely that the Fed's policy will change. We'll have a new chair at that point. And it's very unlikely that they will change fiscal policy. I guess I'm assuming the Republicans keep the Senate, but I know I just said the opposite. But I just think the chances, there could be a lot of political noise and stress. But if you just boil it down to, did fiscal policy change? Did monetary policy change? I don't expect a change there. So again, that's why I'm saying 2026 right now seems like the year of visibility. Let me jump from the 26 midterms to just talk about one other element of that, which is unemployment. Obviously, unemployment is a big concern, and jobs added fell a lot. And a lot of the concerns are around AI. So as I said at the top, I like to steal other people's charts if they're good. And Morgan Stanley had two really good charts here. So this is a multi-decade chart, so it meets our standards, Adam. And it shows, that admins or secretaries fell from 4.8% of the workforce to 1.3 over this multi-decade time period. That's 75%, assuming stable jobs, but that's 75% loss of jobs in a particular category. And obviously, computer programming rose 3x. So these are dramatic changes, but the point here is that these are sloped lines, and that something is falling, but something else is rising. So another chart that sort of has a similar theory here is, again, computer programming versus retail. Here in retail, you did see bigger jumps down, partially due to COVID, in percent of people employed. But this is the effect of automation. And my main point is it's slow. So to think that we're going to have a big shock to employment in 2026, I think it would be against my expectations.
Okay. So those that are ringing the warning bell saying AI is going to just take all our jobs tomorrow, you're saying slow your roll.
It doesn't, if you look at employment stats over the last 100 years, it's generally smooth stuff like this rather than, kind of massive layoffs.
Okay. Two quick questions, and they're kind of both around inflation. You stay on this chart, but back to the chart that showed services versus goods inflation. Goods inflation was rising in the past couple of years, largely due to the impact of tariffs. Do you see that as a sustained rise, or do you see that as sort of a one-time repricing because tariffs, okay, we slapped X new tariff and then we're just keeping it going forward?
Yeah, I mean, listen, what the average consumer says, this is not a great slide because my prices went up and then they never really came back down. They stopped going up. That's all this chart says, but they still are higher than they were 5 years ago, right? That's why this chart is how economists look at it, but not the average person. So, that's why I think on the margin, consumers and voters are very sensitive to inflation now. and want to see prices down. I don't think this goods number continues to rise. Again, it's a lot of it is just, if you look at 24, it went negative, right? Because it got so high during COVID, then it came down, a little bit, and then it went up a little bit. So it going up a little bit is that last thing. I wouldn't focus on it too much.
Okay, great. But just to be clear, you don't expect the goods inflation to really continue rising from here. That said, highly likely to be affordability, highly likely to still be a major voting issue during the midterm elections. On the jobs slides that you had there, so you don't think that AI is necessarily going to create a job apocalypse anytime soon, but we are seeing things like the quits rate being real low and companies just not hiring. And so could AI still be somewhat dampening wage inflation because people don't feel like they've got the bargaining power at work to demand more?
No, I think there's definitely a mentality shift by employers in hiring and entry level. I mean, you see this in the statistics, right? Computer programming is stressed because AI is giving high productivity increases in that particular sector, and entry level college graduates, looking for white collar jobs. It's tough. So I'm not addressing it to say it's a perfect world out there. I'm just saying that there's constantly shifts because of technologies, right? This admin loss of jobs by 75%, you can call Bill Gates and Microsoft, right? That's basically the automation of the office workplace. All I'm saying is it tends to be delayed and deployed over time. But
Got
it's
it.
definitely, I'm not changing the trend.
Got it. Okay.
All right. This is also chart crime. Way too much data, but I wanted to highlight a couple of things. So these are the 5, again, original to VanEck research here, but the 5 sectors of the economy that lost the most jobs in 2025, and I have 24 data, but let's not go there. Effectively. One big thing is, right, there was a lot of layoffs at the federal government level, and that finally rolled through in October and November. So, but if you just eyeball some of these other areas like manufacturing or information in particular, you see that the job losses, Adam, are kind of consistent month to month.
Mm-hmm.
They're not particularly accelerating, maybe transportation. So, so again, most of the
there's
other
a big one in the federal government, but that probably was because of the shutdown there.
Yeah, no. That was the layoffs that took 6 months to go into effect.
Oh, okay.
So, I mean, that was, well, we know about that. But my point is that, if you look at the weakest sectors for employment, only maybe with transportation do you see an acceleration, and even that I would say is probably noise.
Okay, yeah. Retail trade actually, even though we keep hearing about how tough it is out there for the average retail worker, doesn't seem to be a fall off there.
Yeah, and I think this is interesting because remember Amazon laid off some people in the fall, and I think that's these numbers, and I think it is interesting how we're getting more efficient in logistics. Right, people talk about robotics and things like that, and drone deliveries, and that's a multi-year trend that's interesting. So, anyway, listen, I want to move on, but from macro and sort of monetary, fiscal, employment, inflation, my main point is we kind of know what's going to happen in 2026, right? We know what's going to happen at the Fed. If Bessent's not totally wrong, and I'm wrong in saying that he wasn't very persuasive in laying out this new policy for the Fed, that's visible. The midterms probably won't change a lot. I don't think tariffs will change a lot. Inflation is kind of in a good spot. Employment is weaker, but it's not critical, or we don't see signs of criticality. And we don't have historical evidence of massive shifts there. I'm not saying everything is great. I just want to bring up the next market concern. And the next market concern is it's way overpriced, right? So if you remember what Jan thinks and what was happening. So I'm going to do maybe only 5 minutes here on AI compute, but my basic theory is the underlying demand is big, number one, bullet one. Number two, the AI bubble actually popped, meaning the weaker capitalized firms had big destruction in their stock prices. I'm talking about down 50%. And then third, some of the what I call AI 2.0 trades at VanEck, like nuclear power and things like that, they have corrected as well. Thank goodness. I called them nosebleeds. And they went down from the nosebleed seats to the mezzanine seats. So that's really healthy as well. So I'm just really happy. Adam, can you tell? So
I can tell.
So what's interesting, I tried to update this token demand slide, which I borrowed from someone else, and Google and a lot of these firms don't talk a lot about their AI token consumption. They very rarely do. But anyway, we know it's growing every time you hear Jensen Huang talking about insatiable demand, and the hyperscalers. Sam Altman talked about it a couple of months ago. So I'm assuming that that's continuing, probably at a slower rate. It's just went parabolic, and I think that's coming down. The math, again, is tokens, again, are like words in kind of AI speak, let's call it that. And the math is that the demand is going up vertically almost, but costs of processing them are coming down a lot as well. The one thing I would highlight for 2025 that changed a lot is that prompts, there's several signs of AI adoption. And that's kind of my theory for 2026 is AI is embedded in our workforce and increasingly doing tasks that used to be manual, and I can see that at VanEck. So prompts are 4 times as long. The processing of an AI prompt now takes 3 times as long, which suggests that it's asking for a lot more processing, or the tasks are more complicated. And then lastly, if you think about who's using the LLMs, it's a lot less of me and my kids using ChatGPT, and it's a lot more of basically computer programs themselves kind of running other computer programs. And that always seemed very abstract to me, but I saw a demo 2 weeks ago of how complicated it is just to add a single page to our website. It's like a full day work. And I'm like, and even that's automated. And I'm like, man. And now we're developing some AI programs to make that a lot faster. So that's what agentic use is.
So is the punchline to all this, Jan, that corporate efficiency is going to rise as a result across the wider corporate fleet?
Yeah, I think it's yes. Yeah. But the main, all right, let me just continue here. The second thing that people miss when they talk about valuations is these companies are glorious. Scale, we've talked about it, so I'm going to keep it short. They have scale advantages, right? They're able to, like Microsoft and Amazon, their employee base is staying flat, but they're growing their revenue constantly. So they are just profit machines. Now, I'm not saying that small caps won't do okay. We'll get to that in a second, but people are, when they talk about this valuation and they're so worried about how the equity markets are valued, it's a huge trend, number one, like I just showed, and number two, it's generating profitability, and people sort of skirt around that. Well, anyway, so let's just talk about this. It could be, if you're looking forward to 2026, which is the last column, that the profit growth of the Mag 7 will come down from 34% in 2025 and 59% the following year. So yeah, maybe NVIDIA profit growth is, not, 50% or 100%, but it's still growing. So that's mainly what I'm saying is I still feel comfortable with the structure of our equity markets, which is very overweight these top 10 companies because of the underlying phenomena. And you have to kind of analyze this every quarter because it is a risk to the market if some of these assumptions are wrong.
Mm-hmm. Does so the expected earnings growth for the Russell 1000 small cap,
Yeah.
that's obviously a pretty big trend change. Is that largely due to what you just had in the previous slide, that these small companies are all of a sudden really starting to take advantage of the benefits of AI?
I think small companies are benefiting from a lot of Trump policies, frankly. Deregulation, the fall in short-term interest rates does help them because they tend to be a little bit more leveraged, especially like regional banks and things like that. Like Secretary Treasury Scott Bessent specifically called out, kind of regional banks and smaller companies. So I think those things are all going to be tailwinds,
Okay.
not just AI. Okay. The AI bubble concern, this is the image of everything, everyone just buying stuff from each other, and there's no there. It's just Enron 2.0. So I just wanted to show some quick charts of stocks. It doesn't look like it, but this stock was blown up, right? This is down 50% from the summer, from 180, got down to, way less than 90, which is half of that. And so what these companies are relying on is contracts and debt to build out these big data centers, right? And their stock prices were punished for that. And Oracle which is this chart, I really like because it's such a diversified, well-known company that announced a compute deal. It drove their stock price up dramatically, and it's really corrected. I mean, it got so ridiculous last quarter. Sorry, I'm extreme, Adam, but on our internal investment calls, people started talking about the credit default swaps of Oracle, which is like, anyway, it was happening. There was a popping of the bubble. There was a resetting of prices, and the people that rely too much on debt have weaker stock prices, and that's healthy. So the AI bubble to me has popped. Okay, I think I got one or two more slides here.
Okay. So just to be clear though, and you're going here now, I was just going to say, all right, what about the big hyperscalers who aren't as debt dependent but have been on a tear? You think they're still pretty well priced?
Yeah, I mean, but that's why I kept saying like it's okay, in prior quarters that the market is a discipline mechanism, and it was disciplining some companies. It's just that the Mag 7 are in just such a great situation that you may not see it there. And just because you don't see it there doesn't mean it's not happening. And NVIDIA has been treading water. I mean, it doesn't look like it on this chart, but it's been treading water for, solid 6 months, which means that its earnings are growing. It's becoming cheaper. And as you can see here, it's at multi-year lows, basically, on a PE basis. So it's not crazy. Did I convince you?
Yeah, I'm still processing, but let me just ask a general question. So folks who have sort of watched the Mag 7 party rage, but sort of passed them by, over the past 5 years, in their mindset is a lot like, okay, look, these things have overperformed for so long. They just can't keep overperforming like this. It sounds like you think, no, they can.
I don't know about overperform, but I'm very comfortable owning them and I'm comfortable buying them. That's really my point.
Okay.
And it's because, again, to get to the sort of vanEck macro view, because don't look at chart, just look at charts like this. The fact is, out there, the demand for tokens is going nuts. And even, like some of these high bandwidth memory companies like Hynix and Samsung, again, their stocks, kind of hit a wall because people were concerned there wasn't enough demand for their goods. In the last week, they've hit all-time highs. So sure, I'm not saying these stocks always go up. Certainly they don't. And this isn't a forever view. All I'm saying is the reality is the AI trend is continuing, and the fourth quarter gave us much cheaper prices. So if I could just jump to like what we call a beneficiary of this demand, this increase for electrical demand, nuclear stocks. and what I called was nosebleed, has really corrected, right? It's corrected down 40% of the move that we saw last year, if you just base it to January. So,
and this index, what, it went up 100% between April and October?
Yeah, yes, and that's when I said nosebleed.
Yeah.
But it's a solid multi-year global trend, so it's very diversified. This isn't relying on a couple of policies from just one or two jurisdictions. So anyway, so that's again, AI trade still in effect, attractive prices. So anything on that before I move on?
No, I mean, again, you've sort of said this, but what I'm taking from you is just, look, don't worry so much about the wiggles of the stock prices in the near term. The tailwinds that are driving this phenomenon are still very much in place.
Yeah, I mean, people are using, if I go back to that slide, which I will at the end, the excuses not to buy are valuations. And I'm just saying that's not persuasive to me. And it was persuasive to me 3 months ago, right? So I'm not immune to that, but I just don't think it holds.
Yeah.
All right. So a third asset class, I want to talk about private credit really quickly, and I think BDCs, business development companies, are really attractive here. Now, this chart is, don't look at all the numbers. All you have to know is that you really, in fixed income, earn your yield. You generally don't earn, sometimes you earn less, like in the 2000s. Sometimes you earn a little bit more, like the 1980s. But generally, the yield you get is what you get as a return. And BDCs are yielding 9% now. And they were a tough area to be in last year. And this is, remember, where there were a couple of frauds in the private markets. BDCs, for people that don't know them, invest or lend money, to private companies, generally small and mid-sized private companies. But they themselves are listed on the stock market, so they provide daily liquidity. And that's why I really like them. When these concerns emerged, I said, whoa, if there's a crisis in this private credit world, prices could fall to 20% discounts of net asset value. So I said there's definitely downside here. And part of the reason BDCs fell this last year is they expected, as short-term rates were cut, that the payouts from BDCs would be cut too, because they have a lot of floating rate debt. So, but those fears, I think, are priced in. So let me go in reverse order. Yeah, I won't go in reverse order. So these are just the prices on two BDCs. One's run by, let's call it, one of the top names, Ares Capital, and the other is Blue Owl. And Blue Owl is a big name, great company. But they were punished a little bit more than Ares last year. So my main point is that BDC market is becoming better managed. Goldman Sachs had a BDC, Adam, that was run by an independent group, and not their general private credit group. And it underperformed and it had some credit issues. So Goldman stepped in, and they basically now have it the same management team as their private credit group. My only point is there's a lot of brand importance against these BDCs. There's visibility and there's accountability. So I kind of really think that with the sell-off last year, they were down last year. Barron's just mentioned BDCs as an interesting income area in their latest edition. So I think it's attractive. I was cautious last year, and I'm interested now. Let me talk about the companies that manage the BDCs. So these are the BDCs themselves, the pools of debt that trade on the market. The companies got a little wake-up call themselves last year as these concerns arose. And so this is the Ares stock price. I don't really need to say much more. Clearly, it got punched a couple of times during tariffs and then the credit concerns, right? this is a perspective, and this is multi-decade, so it meets my standards, right? Of what I think people weren't getting, which is the context of these private credit companies. So
Wow.
the line I'm looking at here is the blue line, which is the price to earnings ratio of Ares. And these companies used to be kind of looked down as second class companies. And you can see here traded at something like 10 times forward earnings, up, kind of up until they got discovered. And the reason is that they earn a lot of their fees through incentive fees. So not based just on the amount of assets under management, but also on the performance of the funds. So the market used to say, well, that's very nice that you have 10 billion under management, but how do I know that you're going to perform again next year? And if you don't, then you're not earning anything. So I'm not going to pay a lot for your stock. And then something happened in the minds of investors to Blackstone, Ares, Apollo, where the market goes, I love these companies and I'm going to pay a premium, right? I'm going to pay 20 times, 25 times, 35 times, up to 50 times forward earnings for these private credit firms. And, my attitude last year was no, thank you. And so that's where I was a little bit cautious. But now, if earnings are okay, it's still a little bit rich. But if these companies are down, from 50 times to 35, that's much more comfortably in the range of the last 5 or 6 years.
Yeah. Well, and they're paying what, 9% right now?
The BDCs are paying 9%. I don't know off the top of my head what the dividend rates are for Ares.
Okay, but still, if it's in the same ballpark, even though you might have some valuation concerns still, you're making some money back in the immediate term with that nice dividend.
Yeah, so whether you buy BDCs or you buy the management companies, I think you're getting better value than you got last year. So just in the moving forward, I'm just going to touch on gold briefly because I know I'm a broken record on this. We are seeing gold reemerge as a leading global currency. And what we just saw in Venezuela just reinforced the fact that there is geopolitical uncertainty in the world, and that's some of it's generating from the United States. And it was a Biden administration that seized Russian assets after their invasion of Ukraine. It was Trump, right, that went into a South American country and surprising the world. And the world is reminded daily that if the government of the United States doesn't like what you're doing, you don't know what they're going to do about you, right? And that's why, and also central banks, are not in China and India are just not dollar centric. And as emerging market countries grow in wealth, they're just going to be buying more gold. These are just two crazy charts from gold history. Basically,
there's your multi-decade chart all the way back to 1790s.
Yeah, and look, my main point is obviously we went off the gold standard in 1971, but my point is when you have a paradigm change, you can't look backward at your charts. Now here the charts were flat, so it's kind of ridiculous, but I think that's just, it's hard because gold isn't tethered to an income level or anything like that, but I just think that it is a bearer asset that is increasingly in demand from emerging market countries. Emerging markets are passing the developed markets. And anyway, here's another gold chart. The main point is when it changes for various reasons, here it was the Civil War and it was FDR, it moves by leaps and bounds. So don't expect, a well-behaved chart. So when you look at something like this, and if you squeeze the time frame, it'll look similar. Don't be scared out of your position if you own it. Listen, as I said before, I'm not saying it can't correct 20% in the bull market. And technically it's overextended. That's why I'm showing this. But I would, I think all the trends are going to be the same in 2026 and 27 and 28. So I see that as multi-year. Anyway,
All right.
that's my.
So not dissimilar to AI, which is just the tailwinds. There may be some volatility, but the tailwinds driving it are still strong.
Yeah, I mean, for gold, I really see it for many years. I would say AI, we have a 2-year compute shortage. So comfortable with 26 and 27. Not sure about after that. So, whenever there's monopolies like in NVIDIA, there's people coming in after it, and you can tweak chips, you can tweak programming to try to make things more efficient. That's part of the dynamic. That was the DeepSeek concern. So that's part of the cycle. So I don't know. Yeah, the visibility is not as long, Adam.
All right. Meaning, sorry, but it sounds like you're saying you expect the bull run in gold. You've got more confidence it's going to last longer than you do the AI bull market.
I do. I think it's a global shift. And I guess what irritates me is when people talk about, oh, inflation versus gold. Gold's a global asset. If anything, last year, demonstrated we had a fall in inflation and a big rise in gold, right? So the whole narrative is when people talk about the U.S. this and the price of an asset like gold, I'm like, you're missing. Think global. You've got to think global. So anyway, here's some more gold charts.
Sorry, before you get to India, can I ask you a precious metals question?
Sure, yeah, please.
I can't not ask you about your thoughts on silver, given how silver has performed of late.
I'm of the camp that I'm a bullish on copper. I've never really understood silver. So it's obviously appreciated way faster and way more than gold. So I think if it's in a reasonable proportion in your portfolio, if you're really bullish gold and you have, 10 to 20 to 30% of that size in silver, I'll still have dinner with you, but I just don't. It's just been too volatile over history. It's too driven by industrial demand relative to investment demand. So I just view it as a sort of a pale competitor. But
right,
it's a sign of exuberance, right? It's gone berserk, and so has copper.
Yeah. Okay. So there may be some real froth in there, which is kind of a warning to that comment. Let me just ask you this. So it sounds like you're saying that gold is going through a permanent repricing here, or a secular repricing.
Yes.
Do you believe that silver is as well? Forgetting about how high it could go or whatever, but is silver being repriced as well?
Yes. Yes. I guess
Okay.
to the extent you're forcing me. I mean, Neil Ferguson just wrote an interesting piece comparing the world today to, I think it was 1906. And look, the main point I would just say is this fact that the developed markets are shrinking as a percent of world GDP is relentless. And it's happening every year. And the world still wants a global currency. Gold was the global currency then. It wasn't dominated by a world power like Britain or the US. It's just going back to the way it was. Why fight it?
Makes sense to me.
Okay. I guess I would just skip my India charts for the most part. I just articulated my thesis about the world that, India is going to, again, has been a great equity market. It's going to be the size of Europe in 10 years. It was disappointing to people last year because it didn't perform as well as China, as well as the US. So it had a little bit of an off year. I still am pounding the table. I'm super high conviction that country is doing all the right things. They did a lot of pro-business reforms that they continued with last year. I won't get into those. So maybe some other time we do a drill down. I point out that the Indian stock market historically has done almost as well. It's done as well as the U.S. except for last year. Valuations are high, but those companies are just growing, and I'm super high conviction about it.
Okay.
I want to save my time, if I could, for my favorite section, which is the beat up area.
Go for it.
All right. So vanEck has been enthusiastic about Bitcoin since 2017. We do think it's a reasonable sort of companion to gold, but something fundamentally broke in the old Bitcoin cycle. So without getting into a lot of detail, one of the first things about Bitcoin is that the overall supply is capped, and that every 4 years, Bitcoin miners get half the number of Bitcoin for running the network. And not directly synced with that, but there has been a 4-year cycle where Bitcoin has been the best performing asset for 3 years, and then the worst performing asset the 4th year. You will notice that if you can count, you won't count 3 years where Bitcoin was the best performing asset. So Bitcoin not only disappointed, I would call it, traditional Bitcoin investors, and we're in that group, myself is in that group, but it was the worst performing asset last year. So the 4-year cycle is broken. I am concerned about 2026 because that would have been the normal bad year for Bitcoin. And so I think should be more uncertainty around people's Bitcoin price predictions. I guess the last thing I would say on this topic is that I haven't changed my view on gold or our view on gold. So I don't think it's Bitcoin. I think if it goes down further, it's at 90,000 now. If it goes down to in the 70s, that would be a great buy. And typically you want a dollar cost average into a bear market. Maybe we don't get there. We have a split view at vanEck. Some of my colleagues are more bullish shorter term or medium term than I am. I just want to let it rest for 3 to 6 months before I could see getting very enthusiastic. Having said that, I have not sold any of my Bitcoin.
Okay, good to know. So this is sort of a cycle break that you're noting here. In terms of just sort of a foundational reason for owning Bitcoin or anything like that, it doesn't sound like you've seen a change in that because you're obviously haven't sold any.
Yeah, I mean, in 2023, for this reason and because the Fed had stopped raising rates, I pounded the table with both fists on gold and Bitcoin, right? And I'm saying, maybe you can pound one fist on Bitcoin. You can argue, that, it's corrected, but not more than that. And if you ask me, I would still wait a little bit.
Okay.
But anyway, there's an adjacent area. Again, this may be, it's not inaccessible to your listeners, Adam, because we have an actively managed ETF that reflects this philosophy. But tokens and crypto was wiped out last year, and this doesn't show it. But most tokens, even though the stablecoin bill was passed, the average token was down 57% according to an index, the turquoise index, the digital assets 100. You can't really tell from this chart, but most tokens have been decimated last year. And you can see here Ethereum, which is the dark blue line, struggling, right? Struggling. It did great into the 2021 cycle. It started the year optimistic, but it's been changing its tokenomics. There has been a lot of activity on the Ethereum network. So this is kind of the best asset in a really, really bad neighborhood. But I can tell you, my colleagues, Adam, are they're drooling by some of the opportunities that they see in this area. And you may say, Jan, what the hell could that be? I'm just going to give you one example here of a token that performed really well. And I'm sure you haven't heard of it. It's called Hyperliquid. It's a decentralized offshore derivatives exchange, and decentralized also means not regulated. So there's risks around that. But it has the Vanguard, concept of token ownership. And what do you mean by that, Jan? Vanguard, the mutual fund and ETF firm, is a mutual ownership, right? No one owns the equity of Vanguard. No private or no public investor owns Vanguard. Instead, they give back their profits, right? And sort of by cutting the fees on their funds. And that is the concept of tokenomics, where the community, the people that trade on Hyperliquid, share in the benefits because Hyperliquid uses its profits to buy back the tokens that are out there. It generates 1.25 billion a year, and its market cap is 26 billion. Now, you can't argue with the revenue. The revenue is revenue. You can argue with the value, but my only point is that is a valuable asset out there. So if you find the right use case, there are values in tokens. Again, I don't expect your average investor to care about Hyperliquid, but my point is that there is a lot of damage in the crypto world. There was a big sell-off at the end of last year, but the whole year was a disaster for most of the space. There are money managers out there, both in hedge fund form and in ETF, actively managed ETF form, where you can take advantage of this. Now, I'm not saying it, again, like Bitcoin, it's not going to turn around in January. I'm not predicting that. Maybe it will, maybe it won't. But I'm just saying, if you want an area of the market that's been really damaged, then crypto is actually one of them. So if I could just summarize, and maybe we could have a conversation: great macro, great visibility, better fiscal policies from the U.S., which should result in slightly looser monetary policy. We've had falling inflation. The employment market is stressed, but it would be surprising if there was a crisis there. So that's number one. Great setup from the government. Number two, the AI demand continues to be there, but the market disciplined a lot of players in the fourth quarter. And so there's a good setup. Third, BDC's worst performing area of fixed income in 2025. I think good opportunities now worthwhile looking at. They 9% yield. You can buy them on a diversified basis. Gold, broken record. It's reemerging. It's a different paradigm. It's a different world. That trend continues. The U.S.'s action in Venezuela over the last couple of days, again, this just causes people to say, I want to own my own money. and gold plays that role around the world. And then, there's stuff to buy in India and selected crypto. I hate to be so bullish on so many different things.
I love it.
But all I can say is I wasn't bullish on some of these things 3 months ago. So at least there's that.
Don't apologize. I get people all the time saying, Adam, you need more bulls on your channel. And I do, I don't screen for bullish or bearishness, but it is harder for me to find people who are bullish. So it's great to have you on telling that side of the story and telling it so empirically. A couple of specific questions for you. I know you do this to come and educate folks and not to promote vanEck necessarily, but did you say that you have an ETF for that crypto token space that vanEck manages?
Yeah, our ETF ticker is NODE, Node, and it's actively managed. And if people want a lot of information, the portfolio manager, Matt Siegel, he actually used to work with Kathy Wood. So he communicates his opinions. Obviously, because of ETF transparency, you can see what he owns every day, but he communicates why he owns what he owns. And that alone is interesting, at least to me.
That's fantastic. Okay, and when I edit this, I'll put the ticker symbol up there on the screen so folks know exactly where to go. Similarly, does vanEck have an ETF for India?
We have two. One is Growth Leaders, so GLIN, and the other focuses just on their tech sector. It has a very vibrant tech sector, and that's Digital India, or DGIN is the ticker symbol.
All right, awesome. Just very helpful for people to have specific solutions they can go out there and research. So let me ask you this. You made a very compelling data-driven case why you think it's going to be a risk-on year, and a lot of these asset classes should do well. What worries, if any, do you have just statistically, right? Like we've had coming into 2025, people were saying, you know what, we've had two really good back-to-back years in the market, 20% plus. The odds of us having a third year of strong double-digit growth just isn't that high from a statistical standpoint. And then we've had, I don't know what the final number was, but probably 18% year or so in 2025. Getting a four-peat is really rare statistically. And I know, every time you flip a coin, every time you flip it, the odds are 50-50. Are you going to get four heads in a row? Unlikely, but can happen, right? That third time you're flipping it, it's a 50-50 flip still. But do you have any kind of worries just about the math not supporting a fourth year of great returns?
Well, I would say two things. Number one, what's a normal year? You're going to get a 10% sell-off. Like that, like it would be very odd if that didn't happen. So even though I feel like you're not going to get a lot of macro policy surprises, you're going to get market volatility. So that's number one. Number two, let's say that that earnings, the profits go up 10%. Well, people, as we've talked about on this, PE ratios, or what you pay for profits, goes all over the place. And you could easily see profits go up 10% and investors going, I don't care, I'm not going to chase that, I want a lower PE, and the market's flat, right? So even if the profits go up. So I do think valuation is kind of unpredictable, and I don't like to talk about it a lot, but there's a range of that for the market. So it's very unlikely for the valuations to go higher, right? The S&P is in a sort of 20% earnings multiple. We're at historical highs, so I would say that would be the second concern, Adam. Just that PE ratios come down. Therefore,
Cape ratios are at crazy highs. Yeah, or I should say just historic extremes, we'll say. Okay, bonds, just real quick. What's your general thought on bonds for 2026 in terms of how you expect that sector to perform?
Yeah, I mean, I said you only really get your yields in bonds, and I want to get paid, so I'm a higher yield BDC kind of person. I don't see any huge risks to the U.S. economy. So if Jan is going to own bonds, I don't feel like I need to own a bunch of investment grade 2%, 3% bonds, unless with duration risk. We do have some CLO ETFs that I like a lot, but you don't have quite the duration risk there. So that's I'm a risk on guy, right? Especially right now.
Okay. All right. And then last, and I'm just asking you to pontificate here, but this goes back to the inflation and employment discussion we had earlier. So this is a mid-year election. As you said, people have been angry about affordability, or really unaffordability, for a good while now. And even if inflation, stops, goes to zero, it doesn't mean that prices have come down for people, right? That the injury they sustained still is stinging, right? So in a midterm election, usually the incumbent party doesn't fare very well. History has just shown that, okay, the guy promised me the world. We're now 2 years into the administration. Everything he promised didn't come to pass, and I'm kind of cranky about it. So let me vote somebody else into office. So I think the prevailing wisdom is that the current administration is probably likely to lose Congress unless people are starting to feel more chipper, by the time the election rolls around. Given you listen to somebody like the president or Scott Bessent, and they're saying, hey, there's all sorts of tailwinds coming. We've laid great foundations for this in 2025. Just wait, this is going to get great. You're kind of in that camp. You're saying, look, it's a risk-on year. Still should be pretty good. Do you think that this actually might, or let me put it this way, do you think the year has good potential to perform such that it may actually swing the midterms uh, towards the current administration's favor, at least on the economic side of things?
Yeah, I mean, look, it's to your point. It's hard to predict, number one. But there is a scenario where the incumbent does okay in the midterms. It's unlikely statistically, so but I think it's possible.
Yeah. Well, definitely one thing that would swing their way is if people are feeling better economically.
Yeah, so we should, sorry, that's right. That's what I was going to do. I think we need to stress what is the positive scenario for the Trump administration. And Scott Bessent talked about it. You can't make it up through prices actually falling that much. It has to be people feel like they have more income.
Right.
And he said they're going to get more income because they're not going to be taxes on tips, right? There's going to be some tax breaks that kick in 2026, number one. And that people didn't adjust the amount that they were paying out of their paycheck. So they're going to be getting tax refunds in the first quarter. And, he's Secretary of the Treasury and runs the IRS. So he has 100% knowledge about
visibility.
That.
Yeah.
So I wouldn't bet, I would put all my money that that's actually going to happen. Now, whether that extends through the rest of the year, I don't know. But I think they are very conscious of the political cycle. And so, I would think they're going to try to time things to their best advantage.
All right. Well, look, Jan, I cannot thank you enough. These quarterly outlooks from you are so not just interesting and useful, but they're just so appreciated, and I get so much feedback from the audience after you come on about just how valuable they find this. So thank you for putting in the time to do this and for going through it all in such great depth. Is there anything that is on your radar or on your mind that I just haven't thought to ask you about yet?
I mean, I was hoping for extra time. I'd love to talk about Venezuela for a little bit.
Yeah, go for it.
Just a couple of thoughts. My view of the world is over the next 10 years as we are having four huge economies: the US, Europe, China, and India. And other countries in the world have to figure out how they fit into those ecosystems.
Mm-hmm.
And South America is really realigning. If Venezuela can transition to a pro-market economy,
Mm-hmm.
if the Colombian election in a couple of months, and we'll know soon, also moves to the right, South America will be a very pro-business continent.
Mm-hmm.
Chile was just elected, et cetera, et cetera. We've got El Salvador in Central America, Argentina, obviously. So I will say, listen, I don't speak Spanish, but I've actually been to Venezuela. I've traveled to almost every country in South America. I was in Peru last year. The gang situation that people just may not appreciate is unbelievable. What's happened there, and the takeover of Venezuela by the gangs meant that 8 million people, it's really a big refugee crisis, left Venezuela, which affected Colombia, which affected Peru. Gangs.
Right. It's basically a fifth of the population left.
Yeah. And in Peru, like they talked about, like the gangs are taking over parts of the economy. I mean, they talked about the informal economy, but mining, forestry, agriculture, like they're just using violence to get their way. So if this is a big change, it will be interesting from a humanitarian perspective. I like to say there's three big international cities in the United States: New York, LA, and then people often forget Miami. Miami is the capital of South America. And so if things go forward, man, Republicans will have even more of a lock on southern Florida, right? Because all of those, there's so many communist refugees there. So we'll see how that works. That's mainly humanitarian, but if there's more of a pro-business environment in South America, that would be very interesting to see, because culturally we are so close to basically that region, right? So many people go to college in the United States from those countries, so there's a lot of cultural affinity. I'm optimistic from that perspective.
Okay, and so obviously that could have positive implications for sort of the global economy if Latin and South America become more of a,
Yeah,
they get
sorry,
their act together.
I forgot. Sorry to interrupt, but I forgot the most important thing. It
Oh,
doesn't
yeah.
matter at all for markets.
Okay.
It doesn't matter at all. Like, we have oil experts, we have energy funds, we went to Guyana, we've looked at oil fields. It's just not, it's not going to matter that much. They can't just turn on oil production overnight. There's a lot of legal infrastructure. Contracts have to be rewritten on how revenue gets funded, because people are going to have to spend money to rebuild their oil infrastructure. Mm-hmm. So it's not really an economic story at all. The only possible thing I could think about is, again, the U.S. unpredictability, which leads to greater gold demand.
Okay. So basically, Jan is saying, while it might have, near to midterm social social impact, and maybe even, who knows, geopolitical impact, don't really expect a market reaction anytime soon from this that's really truly meaningful. But let me ask you this. So the administration has talked a lot about it, and Trump himself has talked about it a lot, even since extraditing Maduro. The Monroe Doctrine, and saying, look, this is kind of it's a good playbook, and we kind of forgot about it for a while, but we're picking it back up here now. Assume for a moment that the U.S. is successful in its designs on revitalizing the Monroe Doctrine, and they help South America really become, clean up its act, really become a lot more market friendly. They help increase the economic output of that area. We enter into more, sort of tighter trade agreements. So we've got access to resources and cheap labor. They've got access to the U.S. consumer market. Everything's protected by a golden dome. Maybe we get Greenland in the process. Obviously, that's a long process, but to the extent that that was actually successfully pursued and executed, how does that change your future outlook? Does it make you substantially more optimistic about kind of the long-term prospects in the world? Is it more of a nothing burger than people who are advocating for it might think? Do you have a strong opinion one way or the other?
Good humanitarian, nothing burger economics. Basically.
Okay.
I think from a U.S. foreign policy perspective, and this is just a speculative guess, I'm not an expert on this.
Yeah, neither you or I are geopolitical experts. Yeah.
Right, but what the gangs were doing in Venezuela and then elsewhere in the region, and then whatever China was doing and Russia was doing, right? Monroe Doctrine or not, that was a threat. That would have been a big threat to the United States if that continued. And I think that stuff, we don't know that stuff now. Maybe we never will, but I wouldn't be surprised. I mean, look, Trump, like he says, he really cares about law and order. He's a law and order president. And I think there was stuff happening there that no American would be happy with.
Happy with, yeah. And I appreciate you really highlighting that. I get it because my younger sister lives in Colombia, and I've been there a couple of times, and enough to see the Venezuelan refugees that are in all the streets. I mean, and their poverty is just, it's crippling, right?
Yeah.
And the crime as well. Colombia cleaned up a lot of its act during the FARC era and whatnot. But there's still gang influence and spilling over from Venezuela. And my sister and her husband actually there was a home invasion. They got tied up. This stuff is really going on. A lot of us sitting here in America don't really fully understand how real it is from a day-to-day basis in some of these other countries that it's spilling over into.
Well, I mean, and the people in the region, they just don't want it. One, no one actually wants lawlessness in their backyard, right? And you hear stories like that, but and when I was in Peru, Bukele in El Salvador has been extreme on this law and order. Like whatever Trump may say, Bukele is just way out there,
Hmm.
right? I mean, he created those prisons, he threw all those
Right.
gang members in jail. And there were Bukele's, spray painted. His name was everywhere in Peru. And I'm like at first I was like, what? Like, how can people be that conscious? But I think that's what's different to me a little bit, having traveled to Latin America a lot more over the last decade, is there's more of a regional sensibility now. Those countries are so entirely different. They're separated by the Andes
Hmm.
mountains that I think in a way, like, I asked a big, very, very wealthy, successful Chilean businessman, kind of what he thought about Colombia and if he'd ever been there, because he was buying a business there, and goes, "Oh, I've never been there." And I'm like, what? But I think that's more an older generation. Like I think the younger generation, like even crypto communities, media, social media, there's just a lot more, so I think this trend towards pro-business and law and order, I should say in the reverse order, law and order, and then maybe pro-business, I think is will be interesting to see what happens in Colombia.
All right. Well, look, I'll be rooting for it, as I'm sure a lot of viewers here will as well. Jan, can't thank you enough. Last question for you. For people who would like to follow you in your work and your thinking in between now and your next quarterly Outlook appearance on this channel, where should they go?
Yep. On X or Twitter, Jan vanEck #3, and on LinkedIn, you can just follow me. I do try to post like podcasts that I like or videos like the Scott Besson thing. Is so important, so I posted some bullets on that. So, and then the vanEck website has our outlooks. And Adam, I will promise to get you this deck so you can distribute it to your listeners.
Fantastic. So yes, folks, if you want to get the slides that Jan just referred to and had walked through earlier, just sign up for Thoughtful Money's Substack. You can do so for free at thoughtfulmoney.com/newsletter, and that'll be the way to get them. Jan, can't thank you enough, my friend. It's always so wonderful to have you do this.
Happy New Year. Good to see you.
All right. Take care, buddy. All right. Well, now's the time in the program we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual by lead partners John Lodra and Mike Preston. Gentlemen, thank you for joining me. Hope you guys had a wonderful holiday and Happy New Year.
We did, Adam. Thank you. Hope you did too. Really great to be back after a short break.
Great to be with you, Adam. Thank you so much. And in fact, I've got to apologize. I still got my Christmas tree in the background. It's a fake one. It takes all about 10 seconds to dismantle, but I've been so busy that it's still up there. Might as well continue celebrating, right?
Yeah, so I know you guys were quite busy. And as you had warned us, at the end of the year, you guys get inundated with a bunch of client requests for all the end of the year steps that we were advising people to consider taking, although we were advising them to consider taking it before the last week of the year. But I know that there's some procrastinators that always slip in there at the end. So you guys, I hope you get some good times with your family, but I know that the whole team at New Harbor has been working in overdrive to help with all that stuff get done, and then help folks, now that it's the new year, get positioned for the new year here. So anyways, I appreciate you making the time to hop on here, given all those demands. So it's always great to have Jan on. I know you guys at New Harbor are big followers of Jan and the vanEck team. I know that some of the funds that you guys hold are vanEck funds. You guys were the ones that actually introduced me in person to Jan the first time I got a chance to interview him. So thank you for that. So anyways, Jan, quite optimistic. Big risk on year ahead. Love to get your guys' reaction to that. Mike, why don't we start with you?
All right. So thank you, Adam. Really enjoyed Jan's talk. We've been big fans of Jan vanEck and of vanEck in general for a long time. With a quick disclaimer, nothing we say here is construed as a recommendation, but GDX is in our portfolio. That's how right now we take a position in miners. It's done really well. Maybe we'll talk about that later in the program, but we've seen a big move in miners. Of course, we've seen a big move in silver and gold as well. And we don't really think the move in miners is over. So we're big fans of vanEck's viewpoint, particularly their their embracing of alternative assets. So I'd like to just talk about some high points here about what Jan talked about, what we agree with and what we don't agree with. Everything, of course, is in a market is opinions, and we don't know who's right until it's all over. But I think there's a lot of gems in here that I'd like to kind of list out now. He talked about 2026 being a year of greater visibility in macro and Fed policy. That's probably true. You know, the dot plot and the Fed funds target rate predictions are pretty stable here. The Fed has had great success in slowly reducing interest rates. Inflation has stayed tame, and the markets have liked that. We were up 16% or so, I think, last year, 16 or 18%
I
in
think
the
it's closer to
S&P
18, yeah.
500. Yeah, so it was a really good year, other than the whole thing. Liberation Day, April 1st, which started April 1st. That was a quick sell-off of around 22% or so. But since then, it was straight up all year. And certainly towards the end of the year, we saw some acceleration in the real assets, gold, silver, and miners. And so that's been really good for our clients. Our model did very well. And so, Jan says that this is going to lead to a risk-on environment. Well, I think we agree. We may not agree on the actual path of the time frame. We think that we might very likely squeeze to a higher S&P. We might very well get a blow off top. I'm watching the market here. We hit a new high again today. We're at around 6950 on the S&P. It looks like it wants to go through 7,000. I wonder if that will ignite the fires, so to speak. But I wouldn't be surprised to see a little bit of a squeeze or a parabolic blow off top. I think if we get that, it's going to be a signal that we're closer to the end versus not. So maybe we disagree with Jan a little bit there. I think he thinks, or at least he talked about this year being more risk on with an upward bias. I think it might be more of a very short term, more vertical upward bias followed by crash risk. So he talked a lot about taking risk in stock, credit, hard assets. I think you're going to have to be very, very careful if you do so. If you're a self-directed investor, you're going to have to be more tactical, in my view. If you're a passive investor, you should really dial down your equity risk or your equity percentage. If you're a passive investor, get down to 30% equities. That'll bring you through whatever comes, even if we're right and we get a big crash. If you're tactical, watch for that big up move. If we're lucky enough to get that fat pitch, that will be the time to start reducing your equities. He talked a lot about the Federal Reserve as well. Says there's going to be quick but short interventions in crises. I'm not sure I really agree with that either. If there's a big crisis, I think it's not going to be short and quick. It's going to be nothing like that. It's going to be more like the Fed all the time to the rescue. I think that's what we'll likely see. Talked about the fiscal policy and deficits improving, things like that. And I'm not so sure about that data, but he talked about the United States handling higher interest rates. Well, I guess that's true. We've been stuck here around 4.15 or so on the 10-year for a while. The housing market hasn't fallen apart in the last couple of years, which is really surprising to me, when mortgage rates went from 3% to almost 7%. We lived through 10 years of hearing how higher housing prices were justified because rates were so low, and then rates doubled and the housing prices just went higher. It's a head scratcher. But it is true that the US has been handling these rates better. And I have to admit, the 4% 10-year treasury is not out of the long-term norm. It's probably back to the normal range, if anything. So we'll see what that means. I'm not sure it means much. Inflation has been relatively behaved. Employment has softened. Unemployment's gone up a little bit, but it hasn't mattered. It hasn't triggered a recession like the other times that that indicator has suggested that it should have predicted a recession. This time, I think it's the SAM indicator, and you had her on your program. When you have higher unemployment versus 6 months ago, and it goes from negative to above zero, every time it's predicted a recession. Well, guess what? Not this time. So everything's different this time. It's kind of crazy. He talked about some specific opportunities in AI. He suggested that the AI bubble burst. I'm not so sure I really saw a burst, but we have seen valuations quite a bit lower in AI. If we're right about potentially a higher market, a short-term blow off AI is going to do great. In fact, everything's going to do great. He talked about Mag 7s still having really good earnings. They should do great as well. But the big picture is that we have a date with destiny. We're 3 times long-term normal valuations, and we think we're closer to the end of the story than not. In fact, I think that 2026 is likely the year that we enter the crisis of this fourth turning that we've been talking about all this time, and which will eventually lead to a climax. So again, if you're tactical and short term, maybe you can get away with playing the game, but otherwise, I would just be careful. Dial down your exposure or do the old T-bill and chill thing, even, is not a bad idea. Just in wrapping up, I'll try to move through quickly here. He talked about private credit. He's bullish on it. We don't like private credit. We just really feel like it's better off being avoided. I guess I'll leave it at that. Still, Jan is bullish on gold. Obviously, we agree with him there. He talked about being more cautious on Bitcoin. Bitcoin has had a big pullback of 30%. Historically, it does this. It's pulled back to long-term moving averages, and it just signaled a bottom fish opportunity, let's say, on this move from 85,000 to 92 or 93,000. So for those that aren't there, it might be a good time to think about dabbling a little bit. In general, we don't recommend very much exposure there, if at all. We don't think you have to have it because we tell everybody they should have 5 to 10% precious metals. That probably covers you. But if you want some Bitcoin exposure, and maybe a good exposure would be something like 1 to 2% on top of that 5 to 10% metals I just mentioned. And so if you're of the mind to do that, you could buy a third of that position here or half of that position here. We might be at a short-term low. That's what the charts are looking like here to us. Bottom line, let me just wrap up here. Jan is decidedly bullish, I think, across the board, and we're not. So I wouldn't say we disagree. I think we probably disagree on path. So I think that these markets will likely trade lower between now and 2 years from now. I wouldn't be surprised to see the markets 50% or more lower at some point. And based on what I heard, I think Jan probably disagrees with that, but that's okay because that's what makes a market. And so we really like vanEck. It has this alternative viewpoint that they embrace the things that we think will do well, like real assets and Bitcoin. And we're just going to have to take it from there. We're going to have to be tactical, be really careful about being passive and all one thing or all another thing. And reach out if you want to chat with us and get some ideas. We're happy to help.
All right, thanks, Mike. John, I got some questions for you, but first, anything you want to add to Mike's reaction to Jan's analysis there?
Yeah, I think Mike did a great job covering most of the bases. Yeah, we appreciate the thought and the broad-based thought that goes into vanEck and other folks, big picture, fundamental kind of takes on where we are likely going. And just like valuations are black and white numbers, they are very poor timing indicators. I would put
Right.
fundamental, thesis-driven kind of viewpoints like this in kind of the same camp. It's really important to have a roadmap of the likely landscape, but markets have proven time and time again to us and anybody that's been in them, they don't follow the rules of what should happen happens. In fact, there's always twists and turns. So we very much it's important to have that landscape, but not become too wedded to it. And for example, Jan acknowledged that India, despite the very fundamentally strong case that can and has been made, it was a laggard asset in its peer group last year. We were happy to have sold out of it, not because we had any prescient kind of fundamental take that the Indian market was, suddenly the thesis that was supportive of multi-year growth suddenly was no longer valid. Simply, the market started to not value that as much as, so we use technical analysis in various forms to help guide our hands. Same reason why, despite viewing energy as a relatively undervalued asset class for some time, we were very patient not to enter in a kind of intentional way the energy market until the last 3-4 months, and we did so through specifically oil and gas services companies, not the producers, not the explorers, but the services companies, which have been relatively a better performer. And again, it's the market kind of guided us there. And I would use the bond market as another example. There has been probably no market that you can point to that has been more lopsidedly negative sentiment than the bond market. And traditional contrarian takes on things will be, well, that's why you should be very bullish. We have been patiently, very modestly invested in the bond market. Most of our non-equity exposure, non-risk exposure is in very short-term treasuries. We have like a 7.5%, allocation to longer-term treasuries, intentionally small, not because there isn't a good contrarian case to be made for that, but because the yield pressures have been very much in front of us. So I would kind of validate all of what Jan said as being a very thoughtful and certainly a kind of a conceivable pathway. But as Mike pointed out, markets have a different way of interpreting things. And just like I'm sure we'll talk about the silver market in a bit, there's compelling cases to be made for silver going straight to 100 as well as back into the 50s. And each one, you got the job of an investor is to handicap those odds. But it's, anytime someone thinks, especially in markets like this, that you have a, certain probability of one outcome or another, one should just remind themselves that they're going to get schooled like markets have time and time done. So, just a couple broad perspectives there. I know you had some specific questions though, Adam.
Yeah, and first let me say, I really value Jan's outlooks for a whole host of reasons, but one of which is, as I said in the intro, vanEck is a massive firm, and they have ETFs and assets in all sorts of different sectors. And I think one of the great values of Jan is he kind of sits at the center of all that. He gets to have a gazillion different discussions across a zillion different industries and different countries and different asset classes with a whole ton of people. And so I really value his sort of synthesis as the guy who's at the center of all that information flow. A couple of things you said, John. I've recorded a couple of videos this week. I'm not entirely sure how many of them will be out by the time this video releases. But like Michael Howell, the liquidity specialist, he is sort of predicting that next year is probably not going to be such a great year, and that we might even have a couple years of rough sledding ahead of us because of liquidity flows, which is a whole other dimension that I didn't get a chance to talk about with Jan here. He makes some cases for assets like bonds that, again, are, to your point, John, really contrarian plays here right now. So what's interesting is I think Jan is right, where we probably have a lot more visibility going into 2026 than we had in recent years, especially going into 2025, where we had no idea at the beginning of the year what was going to happen with trade and all that type of stuff, right? There was all an unknown, and then everybody freaked out when Trump came out with his poster board on Liberation Day. This year, we do seem to have a lot more clarity into what's going to happen in terms of the decisions that we're going to make. What we might not have is as much clarity into actually how things actually unfold. And one of the things I talked with Michael Howell a lot about is, don't forget, while the market has sort of metastasized to become so large in our financialized economy, and it's kind of become the tail that now wags the economy dog, the markets and the economy are still two separate things. And you can have a year where the economy actually does quite well. But the markets maybe don't.
Yep.
And right now, I think too many investors just assume that they're always going to be, correlated, have a correlation of one. And this may be a year that maybe re-educates people on that. So anyways, my point is just, it's so great to hear the wisdom and the expertise of guys like Jan and some of the other folks that we're interviewing. It's going to be a really interesting year to see what actually plays out in practice. So real quick, in terms of the year that we just had, John, that actually, I believe, was a pretty darn good year for New Harbor. Maybe even your best year ever. Can you just talk for a moment about what the past year was like for you guys?
Yeah, happy to. And I first have to take a huge dose of humble pie, because any investment manager that starts talking about performance, we look at things every day. We come in as a brand new day. It's great to have good years, but all that matters is where we go from here. And we try very hard to set our framework and our mindset that way. Yeah, we were up. I mean, certain clients have different tilts depending on their situations, but for our core tactical portfolio, we soundly beat the S&P 500. I'll say that. We were up net of fees in the ballpark of 20%, plus or minus. And again, this is first thing I want to say is I don't want anybody hearing that and making any kind of extrapolation into any future. I would be shocked if we could do similar to that this year, to be candid. Please take that with the grain of salt that backward-looking commentary deserves. I think this year is going to be quite a bit more challenging. Where we had some really good success, obviously we've been bullish in precious metals for a long time. Last year was very, very constructive for precious metals. In some ways, too constructive, and that's why we have some hedges in place, and we're bullish, still bullish long term, but we do have some concerns about the near term path that they might follow. We very intentionally, even though we're underweight equities, we were in certain sectors that were strong outperformers relative to others. And we had a very intentional, overweight relative to the market for sure, or traditional investment, kind of allocations, overweight to non-US equities. So emerging markets, we were not in India, but we were in things like Latin America, for example, which did very well. And again, this is all backward looking, not a recommendation going forward. But our simple recipe, if you will, and it's not a perfect recipe. We're always learning new things every day, and our system is always teaching us new lessons. But you want to be in the areas that are relatively strong, out of the areas that are relative laggard, no matter what the fundamental case is. As I said, like for example, energy we felt has been very undervalued relative to the market. But it was a big laggard for most of last year, and we held off investing in that until we got some technical signals that confirmed some momentum in that space. I do want to comment this year ahead. In the a bit of put this in your contrarian kind of bucket of caution. You look at Wall Street analysts right now. There rarely have been this uniformly bullish, and the degree of bullish. There's probably examples that exceed this, but we were just, I don't know if Mike, I don't know if it was the Barron's kind of roundtable. We were talking about it in our investment committee as a team last week, and that alone should be enough reason to have some caution, even if the fundamentals, even if the economic outlook is supportive. Usually, there's some contrarian wisdom in going against the crowd in that regard. So we expect, as Mike put it, and I'll put an emphasis. Quite a bit different pathway than Jan. Right here in the moment, our technical indicators are actually quite bullish. I would say, yeah, here and now we're quite bullish, but that's a very tentative, and we have little doubt that will change, before too long to become constructively less bullish and quite likely even quite bearish as we get further into the year.
Okay. Well, so folks, we're going to hopefully have Jan on every quarter this year to deliver his quarterly outlook. So you'll get to see as Jan's thinking evolves across the year. And of course, we'll have the New Harbor guys on every week. So you'll see how their thinking evolves as well. On the energy side of things, John, you said you were sort of waiting to get the green light from the market that it was time to enter. So you did. I know that's still a relatively recent trade, but what have the technicals been telling you, and what, if any, impact do the recent developments in Venezuela have on your guys' outlook for energy?
Yeah, obviously there's been some recent headlines that affected the oil market. Let's start with the knee-jerk reaction. Okay, Venezuela's got, I don't know what the number was, 300 billion, barrels of oil or whatever the number was. First thing I'd like to make is OPEC numbers, firstly, are numbers that are given to them by the members. They're not independently audited. And if you look at actually the history of Venezuelan numbers in that survey, it wasn't until fairly recently that, I don't know if it was under Chavez or under Maduro, but there was a big jump there. It's essentially a political messaging jump. So, you have to take it a grain of salt, firstly, what the supply even is. Add to that the type of oil it is, the heavy crude.
Very heavy, yeah.
Yeah, very heavy, very complicated and messy to refine. It just so happens that we have some,
We have the refineries that specialize in it.
yeah, and we read a fascinating historical, I forget who it was that put it out there, but I learned quite a bit about the history, just in the shadows of Fenway Park, where the Red Sox play. For those that aren't familiar with Fenway Park, there's a big Citgo sign.
I was going to say the Citgo sign.
Yeah, and I just knew anecdotally that Citgo sign had a very Citgo had a very history relationship and connection to Venezuela. And honestly, I wasn't quite sure about how that played out and what the current stat was, but it's fascinating history there. And long and short of it is we were getting cozy with Venezuela. We started, at the time, we here in the U.S. we thought the light sweet crude days were over, and we needed to posture to be able to process the heavy crude that was elsewhere in the world, including Venezuela. And then, of course, the shale revolution came about, and it suddenly unlocked massive amounts of the light sweet crude, and much of which we have to export because we don't have the refining capabilities to the degree we have the heavy crude. So in some ways, you can view this as not about oil, but a massive geopolitical game that you dovetail that, and by no means are we experts in geopolitics. Geopolitics. I know, Adam, you just mentioned the geopolitical interview you just did, but you dovetail that with Marco Rubio's comments, not so veiled comments to China and Russia. Hey, we control the Western Hemisphere. Stay out of our backyard. I mean, this is way bigger than oil, and I agree with Jan that this is not likely to have any immediate kind of tangible market effects on the oil market. Longer term, it quite likely will, but all this stuff that we've seen in the energy market was coming before this sudden weekend news that we invaded or did an operation in Venezuela, however you want to frame that. So I agree. This is probably just news circus headlines. That's not really, certainly doesn't affect our reason for being in the space, and won't, we think, have dramatic near-term impacts on the energy market. There's plenty of other things that will drive that.
All right, but Venezuela aside, as you look at your newfound energy position, are you looking at it as, hey, we've made it? Are you looking at 2026 as an additive process for you in this sector?
We'll see.
Or has something changed?
Yeah, we'll see. We'll let the kind of the technicals guide us there. We're not in love with it for any fundamental reason. If the prices start to kind of erode and we see relative strength pick up in other sectors and weaken in the energy sector, we'll have no qualms about trimming or taking stops on a position there.
Okay, Mike, I'm going to give you the last topic here, which is the precious metals, something that you are very much an aficionado in. They've cooled off a little bit today, but gold and silver pretty much hit new highs just a couple days ago. Yesterday, silver got back up above, at least silver futures got back up above $80 an ounce. They're like a buck or two below that the day we're talking here. But, what was it? Not that long ago, a week and a half ago, folks were starting to bite their nails of, hey, we just saw a 15% correction in the price of silver. Is this, did it just peak out? And are we starting to see a big, massive correction like we saw after the previous two peaks? Realistically, jury's still out on that, but we've seen some pretty strong resilience in silver since then, and in gold. What are you looking at most closely right now?
Yeah, you're right, Adam. We've seen some really good resilience. Let me share some charts here, and then we'll go through it. This is a chart you'll see in a second here. This is an ETF that tracks silver. It's SLV. It's the easiest thing to show.
Okay, this is the monthly, right?
This is the monthly chart of SLV. That's right. So take a look what happened back here in 2011. We hit a high and we basically came right back down the following 4 months. This time we broke through that, and now we have 1, 2, 3 months that we haven't immediately rejected. I guess I'd submit that part is different so far, right? And silver might very well be the largest triple top that, in nominal terms, that I've seen in any chart. 1980, 2011, and just now we hit $50 an ounce. But of course, we're up to $80 an ounce. It is decidedly different, at least on the monthly chart. So take a look at the daily chart. It's been all over the place. This is the 21-day moving average. This is the 50-day moving average. And just today, silver's down $3 and change. There's a lot of people out there on Twitter and on the web saying, you know what, this is probably or it could be a double top. So there's a lot of skittishness. Maybe it's a double top. I don't know. There's a lot of air here between the current price and even the 21-day moving average. So I would say anything's possible, but trying to call a top here has been a fool's game. I can tell you we're seeing a lot of skittishness even in diehard bulls, and that to me is a relatively good sign. Not a good excuse to go in too heavy. Still think you should be selling on the way up a little bit at a time. Those people that have bought maybe 10% back when we were recommending it all these years now have 20 or 30%. Sell 5%, something like that up here. It's going to help you refresh your mind. It's going to free up cash to use for other meaningful things and maybe even other meaningful real things like construction or buying property or things like that, or even a vacation. So don't forget to ring the register a little bit, but I don't see any indication here that this top is in. I guess we won't know till we know, but I wouldn't have thought that we'd be up at $78 an ounce, which is where we are right now. It's kind of amazing.
And that's despite your pretty strong bullishness on silver heading into 2025.
Yeah, I was really bullish about it. I didn't actually think we'd get to even where we are here. But I've also learned that I can't call a top or a bottom precisely. Nobody can. The gold silver ratio, show that here, has now normalized. I remember talking about this back in Liberation Day. We were saying, the gold silver ratio is like 103, right? And this is just a year chart, but 103 is pretty rarefied time level. It's only seen that a few times in the last 20 years. And now we've come all the way down to 55. I'd say the long-term average over the last 10 or 15 years for the gold silver ratio is 40 to 60. So down here in 55, we're at the top end of that range. I don't think it's a screaming valuation advantage for silver versus gold anymore. I think that easy money's been made. But having said that, I don't see any reason to believe we've seen the top in silver or gold. So there again, the daily chart. I don't know. We might chop around here and then go higher. If you take a look at some of the mining stocks, particularly silver miners, a lot of people have been saying here's SIL, silver miners. They have lagged a little bit. They're still up quite a bit over the last year, close to the same amount as silver, but we haven't seen the multiplication effect there quite yet.
Yeah, there's a lot of head scratching going on right now about that.
A lot. And, I kind of attribute it to nervous Nellies a little bit. There's a lot of, the diehard kind of gold and silver bulls. They're looking to ring the register left and right because they've been out of the money for so many years. And they keep thinking we're going to see the next big collapse. It just hasn't happened yet. So I don't.
Sorry to interject here, but to the extent that prices remain at these levels, then price really is your friend as an investor in the miners, right? Because the one thing you can't deny is earnings, and if these companies start or continue to produce great earnings growth because the product they're digging out of the ground is now worth a lot more, eventually Wall Street's going to have to take note of that, correct?
I think so. Right now we're looking at a chart of the gold miners GDX, which of course happens to be a vanEck product, and it's in our model. I think that the earnings are likely to come through in the next couple of quarters, assuming they didn't hedge away the advantage in mass, and I don't think that they did. It should come through very positively. Here's GDX. It has essentially doubled off this base early in the year. And we've talked about this before. When you have a big bull market kick off, particularly in commodities, you'll often see a doubling, then another doubling. So when is that next doubling going to come? And again, this is not a projection or a recommendation, but if you take a look at some of these things like SIL, the silver majors, we doubled off that 40 area up to 80. And now we're chopping around. And a lot of people are thinking it's the high. And I don't know 100% for sure either, but I believe that we're going to start seeing some positive earnings reports, and I believe the big picture is that these things might double again from here. And that's where you get the real multiple expansion. But that's the head scratcher, right? Going back to silver, silver's had this vertical move. Silver miners and even gold miners haven't had the same vertical move. Is this some kind of signal? Is this a negative signal? Or are the miners just going to catch up in their own time? That's the hardest thing, Adam, to say. And like all of investing, you have to have a bias and make a guess. I believe that we're going to see that expansion come through in the miners.
So
Maybe I'm
we'll talk
wrong.
about this with a mining chart in just a second, but looking at silver here, again, two guys that have been quite bullish on silver. You've been touting it for a long time, Mike. I had my, silver laser eyes that I put on my X profile back in June. Um, looking here at the current silver price versus its moving averages, which are the colored lines there. This is a huge deviation, folks, right, from the moving averages, and so uh, those deviations don't last. So what's either going to happen is the price is going to come down to get more into historical context versus these moving averages, or it just might cool off and give those moving averages time to catch up to it. We'll see. But Mike, as you've often said, when you have technical momentum, the trend is your friend, right? And so generally you play it, right? I think you've even said the trend is your friend until the end, right? Um, I don't believe, correct me if I'm wrong, while yes, this trend might reverse and maybe as I said earlier, the price comes down to match the moving averages. But right now, we're not yet seeing signs of a trend breakdown. Would you agree with that?
Yeah, I think that's absolutely true. We're looking at a weekly chart, and there's a lot of air here. It's true, but that does in itself is not a signal that we're going to see an impending collapse. On a weekly chart, we had this triangle back here in October. We broke out of that, and it was one, two, three, four, five straight weeks up. And now we're chopping around on SLV between 65 and the low 70s. A lot of people might be looking at this chart and say, well, look, we have a shooting star here, potentially. Maybe, but it's only Wednesday as out of the time of this recording, and we don't know what's going to happen. So no, there's no trend break. And if I went back to daily, we'd have to come all the way down to maybe 65 or even 62 on SLV before we even talk about a trend break. And that would bring us down to maybe 68 or 70 on silver, which is right at 78 now. So,
Right. Which we would have been thrilled at if we heard 6 months ago that that's what
I
the price
know, but that's
would
what's
be.
hard. It's hard to hold on, I'll tell you. Real bull markets are hard to hold on. And the market will do everything possible to get you out and play with your emotions.
All right. So,
So
so Mike, if you could pull up whichever chart will best show it, but I'm guessing it's GDX. You mentioned you guys had some hedges on the positions now because they've moved so far so fast. Where are your current hedges in this space?
yeah, we only have it half hedged. So first of all, we admit that this is a powerful bull market and we don't want to cap it. At the same time, we want to have something in place so that we can reduce volatility. Right now, our call option is at 880. Okay, so on half of it. So that means on half of it, we're capped out. But the other half of it is unencumbered. But we also get accumulated premiums for that half. So it's not really easy to say exactly where the break even would be. But I can tell you on a big pullback, we would get more bullish because as we come down towards that line, we move more towards 100% in the position. As we move away from that line, we move more towards 50% exposed. And then the premiums that we take in for that half hedge part accrue to the account. So we use pullbacks like this to reset those hedges. We just did it here. So we'll see. If we go straight up from here, well, I guess that's going to say that on half of the position, we're missing out on further upside. Overall, we're okay with that in exchange for the overall experience of dampening the ride and staying on board. This has not been an easy thing to stay on board these last few years. And even now, it's doing its best to throw everybody off, including the diehard believers, right? So we talked to a lot of people in the audience. Your audience tends to be more believers in gold and silver like we are. Sometimes we have to walk people back from an all-in mentality when they say, well, there's nothing else to invest in. I might as well just put everything in gold and silver. And, they've been right. That's been right. But all-in mentality gets you hurt and it gets you a little bit stuck sometimes mentally. We sometimes see people like all-in miners, and then they get shaken out on the first big downturn. If I go back to like silver juniors, for instance, just a few days ago we had a downturn, and that, that doesn't look like much, but that's painful. And these downturns shake people out, and they start to question their beliefs, and they stop out. Get your position in place and just let it be. And if anything, sell a little bit on the way up into strength to rebalance yourself a little bit. That's the way. If you're hyper focused, hyper emotional, you're gonna get in trouble. This silver junior miner, since we're looking at it, the chart looks great. Cup and handle, breakout, but look at all this chop between 27 and 30 on this ETF. A lot of people out there, I guess including me even, are saying, what the heck is going on? Silver's going vertical. Aren't these miners supposed to go vertical too? All I can say is give them time. It doesn't happen on your time frame. It happens on the market's time frame.
All right. Well, very well said, Mike. We'll have to end it there just in the interest of time. Real quick, you were talking about the folks who went all in and then maybe got shaken out in the recent price weakness there. I had Andy Scheckman on. Thoughtful Money's endorsed precious metals solutions provider, his firm, Miles Franklin. And Andy, talked at length about that in a video I just released with him a couple of days ago, about how he thinks that was actually kind of engineered, by the bigger longs now, the institutional longs. They call it shaking the bushes. It's just literally to try to bang the price down to shake out the weak hands, buy silver at a lower price, and then ride it right back up again, which obviously seems to have happened over the past week. Andy also is quite bullish about silver's momentum from here. The title of the video was has silver peaked out here? He gives a very strong argument for no, and gives a whole bunch of reasons why. So folks, if you want to get kind of the latest on his precious metals thoughts as an industry insider, go listen to that video. But also just a reminder that Andy, for folks that are still looking to either get in for the first time or to add to their positions on the silver side, he has been offering the Thoughtful Money audience for about the past month or so an exclusive price discount on junk silver. And he was offering it at $1 below spot. And kudos to everybody who took advantage of that. One, because silver's higher today, but you bought it at a really good price. So he can't, because of the recent CME hikes, he can't offer the same quite low price, but he's now offering, while supplies last still, of course, now junk silver at just $1.35 over spot. So if you want to take advantage of that, just go fill out the short form at thoughtfulmoney.com/buygold, and he and his team will respond right away and either get you hooked up with that offer, or if you've got other questions or needs around buying precious metals or storing them, he and his team will definitely be happy to help you with that. All right, gentlemen. Well, look, great kickoff to the year. Thanks so much for coming on this week. Look forward to 51 more weeks of doing this with you guys in 2026. Kudos to you and the whole team there at New Harbor for having such a great year last year. And whatever happens from here, very much appreciate you guys tracking it for my viewers here in real time on the channel. All right, folks. Well, in wrapping up, if you again enjoy these quarterly outlooks with Jan, would like to see them continue, please let us know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon next to it if you haven't clicked that already. And if you would like to get help early here in 2026 in setting your personal portfolio up for what is likely to happen this year, whether it plays out the way that Jan thinks or some of the other experts on this channel think, highly recommend that you get that help from a good professional financial advisor. If you don't have one that's already providing that guidance to you, well, and consider talking to one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. You might even like to talk to John and Mike themselves there at New Harbor. So to set up one of those consultations, which are totally free, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. As I said, these discussions are totally free. There's no commitments involved. It's just a service these firms offer to be as helpful to as many people as possible. John and Mike, again, can't thank you guys enough. Look forward to spending the rest of the year doing the same thing right here with you guys.
So happy to be here. Thanks again for the opportunity. Happy New Year to everybody. We'll see you next week.
Thanks again, Adam. I think we're going on something like 15th or 16th year, kind of being friends and collaborators. So we appreciate this opportunity and we look forward to a great year ahead.
Yeah, I think this is year 16. And it has been a wonderful partnership, and I look forward to at least 16 more with you guys ahead. All right, thanks so much, boys. Everybody else, thanks so much for watching.
Japanese yen is one of the worst performing currencies versus gold, which in my book is inflation. I mean, not that gold isn't breaking out already, but I think silver will accelerate. And like Phil said, for people who haven't bought gold, I guess silver will be the alternative.
For a person, yes, you always want to go seek out as much gold as possible. When a system has a lot of gold revolving around it, you only get two things. You get more jewelry and you get higher prices. So if China reveals they have 30,000 tons of gold, like that, like we think they might, then that means prices in China in gold terms are going to be sky high, and prices everywhere else are going to drop like a rock.
25th of September, the consultation period over whether silver should be a strategic mineral in the United States will finish. They'll have to start building a silver stockpile. And we don't know how big that stockpile will be. Obviously, in the past, it was 2.1 billion ton. If there's a disruption in the supply from Mexico, which is where they're getting most of their silver from.
One of the worst currencies in relation to gold has been the Japanese yen, underscoring the growing pressures of inflation. Silver is predicted to rise quickly as a substitute for gold for those who missed it, even if gold is already starting to break out. By September 25th, the United States must decide whether to designate silver as a strategic resource. The government would have to accumulate 2.1 billion ounces, which is almost 3 years' worth of mine supplies, if it were authorized. Since Mexico supplies a large portion of America's silver, any disruption there might have a significant effect on the U.S. sector. Experts estimate that there is a 4% chance of such a situation. Mario Ineco, a famous market strategist, and Phil Lowe, a sharp macroeconomic commentator, both highlight that since April, the Dow-to-gold ratio has fallen precipitously, and it currently exhibits trends reminiscent of those seen in 2007 before the financial catastrophe. Long-term charts indicate otherwise, despite some people's concerns that a liquidity event may put pressure on gold and miners. It's evident that the trend is strong because banks like Goldman Sachs are now predicting that gold will reach $4,000 by mid-2026. While silver targets are already almost reached. The wider breakthrough indicates that gold's bull market is well established, even in the face of possible short-term pullbacks. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
This one here is the Dow gold ratio, and we dropped quite a bit in April when we had that beginning of April, and then it's being consolidated, and now it's breaking down, and it looks a little similar to this, and this was in '07 before the great financial crisis, but I mean, we'll have to see anyway.
One thing I may, because we were just discussing Weimar, I do want to stress that Weimar was a very unique situation because the Entente powers were not letting Germany default. They said, you cannot default, you have to give us gold. And that's what stretched Weimar out to 2 years. I want to reassure the viewers, like, I think this will be over in 3 to 6 months once it really gets going. It's going to be brutal. It'll be as brutal as Weimar, but it'll be a lot shorter.
Yeah, but in Weimar, it started taking off. The hyperinflation really picked up in the summer of 1922, and by 1923 it was over. So it was about 18 months. And
I think this will be about 3 months. I think they'll once they start losing control of food prices, I think they'll revalue to gold.
Now, I thought commodities were going to start a bull market in the early 2020s, only because bonds, I thought were going to start a bear market, and I thought hard assets will benefit in relative terms. But we see now that banks like Goldman Sachs, who usually just push paper and derivatives, they're actually telling their clients to diversify into commodities. And I think they said that they expect gold well above 4,000 by mid 2026 if the Fed's independence is damaged. So I thought that was interesting.
Yeah, I see that. Well above 4,000 by mid 2026 in the middle of your page, Mario. I see that.
Yeah, it's here. Yeah, right there.
Their calls just follow the market.
Yeah. The other couple of weeks ago, Bank of America, which is another bullion bank, they said, "Oh, we're bullish silver. We see silver at $42 by the end of 2026." And I thought, that's not bullish. We're almost at 42 now. So, the bullion banks, I mean, I've been following them since I started following gold in '02. And I mean, now they can't do it anymore because gold is in a massive bull market. But for example, a few years ago, if gold was like 1,500, they'd say, "Oh, in the next few years, we expect gold to revert back to 1,000," and like so on and so forth. But now, they're saying they're bullish, but I think they're not bullish enough. And one of the reasons is these couple of charts here, and I'm going to bring them up. First one is a bit more short term, and this line here, we're going to see in the longer term chart. I think it's really important. And it was around 2,700, this line. And that's why I think we saw this pullback, in the retest. And now as well, I mean, we've broken out of this pennant or symmetrical triangle, and it's really taken off. And there's nothing like above here. So that's very bullish. I'm not saying we won't see any corrections, and then this one is the same chart, but really long term. And this is why that 2,700, in my opinion, was so important. And I was waiting for that
Wait,
test.
Mario, can you flip back to the other one so I can see the
Yeah.
difference for a second? Okay, yeah, and then go to the forward. Okay, okay.
So this is from the high in 1980 to the high in 2011. That's where that 2,700, when we're breaking out here, I thought we might see resistance at 2,700. I mean, we didn't initially because it went up quite a bit, and then I'm not sure, it went 2,900 or something, and then it broke back down. I think it was after the Trump won the election. But now, I mean, we're really taking off, and a lot of people don't look at these long-term charts, and this is why I think yeah, people are concerned about a liquidity event.
Rafi Farber, known as the Endgame Investor, in an interview with Phil Lowe, Mario Ineco, and Clive Thompson, points out that China is injecting funds into its banking system through what it calls reverse repos, essentially providing liquidity much like Western repos. The government is trying to reflate its struggling economy, which faces weak exports to the US and a collapsing property market where apartments, once the main savings vehicle, are now oversupplied and losing value. This has left many Chinese households cautious about spending. While some argue China could rise as a global power, others believe its fate is tied to the West. If US consumers are broke, Chinese producers suffer too. On top of this, China holds vast US dollar reserves that may lose value, and even its large gold stockpile could backfire by pushing domestic prices higher and undermining exports. In short, both China and the West are trapped in the same fragile global system, and neither has outsmarted the other. Let's revert back to the...
This is the case. I think when China refers to reverse repo, they mean what we would mean by repo. I think they just got their terms.
Yeah, they are buying. I think they're buying the government bonds from the banking system and injecting cash into the banks.
Yeah, so
US is the other
that's what
way
we would
around.
call repo. In
Yeah,
China, they call it
yeah,
reverse repo.
yeah,
Whatever. It means they're injecting cash into the banking
yeah,
system.
yeah.
I didn't hear about this. China they're like on a different wavelength because their interest rates are going down and down and down, and the West interest rates are going up and up and up. I still think that when the West falls, China falls with it because they are the producers and we are the consumers. So if the consumers fall, the producers fall too. Like if you lose your customers, you lose your income. Or if the currency collapses in which you're getting your income, then you lose your income also. Uh, why China would be injecting cash now? I mean, we know. I mean, the place is very opaque. It's still communist, except for the special economic zones that they allow freedom in, so they can supply the West with a bunch of stuff, so they can stack more dollars. But China's economy has been so fake for so long, and they still have these ghost towns and this whole real estate bubble throughout the whole country, and it's still like a very corrupt, disgusting regime. I mean, we're not allowed. We don't really say that because the West gets most of its stuff from China, but that's still the reality, and it's gonna have to go.
Not very different though from our regimes.
That's true. No, I guess in the way it functions, no, but at least I mean the West still has an idea of individual liberty, whereas I don't think the Chinese see that as a value at all, other than maybe a temporary expedient. There's still a feeling in the West that individual liberty is a good thing in and of itself. In China, that was never there.
Things, the Chinese injection of funds, or
I mean, they want to reflate the economy. The China's suffering obviously from the slowdown in sales to America on the one hand, and secondly, the way of saving traditionally in China has been by buying apartments. So many Chinese people bought apartments, and now suddenly they're finding that the bottom's fallen out of the market because there's far more apartments or houses, if you like, than there are people to occupy it, and the population is not rising anymore. So and a lot of building companies have left these blocks of apartments which they're building and that people have paid for. They're half empty. So suddenly everybody is now drawing in their horns saying, oh my God, my traditional form of saving isn't working, and they're not willing to spend money on things. And so the Chinese government definitely has to reflate the economy. I think we're going to see more of that. I think that's just a first step, and we'll probably see more money thrown at the economy sooner or later.
Oh yeah, there's a lot of people who think that China is somehow eating our lunch, that they've somehow outsmarted us. And I think your friend King Kong Eric Young is always talking about the rest of the century is going to be the Chinese century, where China's going to move to the forefront.
yeah,
I don't
think
think
Jim
that's true
Rogers
at
said
all.
that too, didn't he? Jim Rogers, I think, yeah.
Yeah, I don't think that's true at all. I think we're going to see. I mean, we're all going to go down together. It's not like it's not like we're going to do fine and they're going to collapse. They are holding enormous amounts of American dollars. We took all their stuff and we gave them dollars, which we're going to default on, and so all the people holding dollars are going to be completely broke over there. Not to mention they have overbuilt their industry, and maybe some people say, well, it's better to be overbuilt than underbuilt, but they're going to have a bunch of factories with absolutely no one to sell to because we are broke. America's broke, so we can't buy any more Chinese stuff, and there's not going to be anything in China to sell. There's not going to be anyone to buy. They can maybe sell domestically to their gold holders, and gold and silver holders, but most of the Chinese are also broke because instead of going to gold, they bought a bunch of real estate. So to say that if you think the Communist Party of China is somehow doing better than us, then we should not have a free society. Then communism works, right? If you think communism works, if you think China's beating us, then that means communism works, and maybe we enjoy our personal liberties better, but communism is now a better state. And
Well, I didn't say that.
Yeah.
I'm just
I know you didn't. There are Chinese.
I'm
Chinese
just reporting on the injection of funds.
Yeah,
But
absolutely.
I think China though has a lot more gold than they tell us publicly. They've got a lot more than 2.3 thousand tons.
That's also not that's not necessarily a good thing, because
Yeah.
gold has having lots of gold in a system. I'm not talking about a person, because people mistake what I'm trying to say. For a person, yes, you always want to go seek out as much gold as possible. When a system has a lot of gold revolving around it, you only get two things. You get more jewelry and you get higher prices. So if China reveals they have 30,000 tons of gold, like we think they might, then that means prices in China in gold terms are going to be sky high, and prices everywhere else are going to drop like a rock. because we will want to sell them stuff to get their gold. Now, what's that going to do to Chinese industry? It's going to collapse it. Chinese export-based industry when prices are sky high in China. So they have all kinds of problems on their end too. It's not like they are not outsmarting us. They're not outsmarting the system. The system is stealing from everybody around the entire world. And we Americans are sitting in drowning in debt. And in China, they're slaving away for American debt that's not worth anything. So they're slaving away for nothing.
Both the US and China face mounting economic pressures. Whether it's America's debt-driven push toward hard assets like gold and silver or China's struggle to sustain growth amid a real estate bust and reliance on weakening US demand. Precious metals are increasingly seen as safe havens in this fragile global system, and their rising momentum underscores a deeper shift away from trust in paper assets. Could silver's potential designation as a strategic resource accelerate its price far beyond current projections? If China reveals its true gold reserves, would that stabilize its economy or trigger more volatility worldwide? Feel free to share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.
Central banks are making out of US dollars and out of US treasuries into gold. And that has been the primary driver of the gold bull market. And gold has outperformed the S&P so far in the 21st century, 25 years. And this is going to accelerate. And not only is it going to accelerate among central banks, but institutional investors and retail investors are going to finally start to participate. So, a $10,000 gold price is not that far off. It's only about a triple from here. But I think it could easily be done over the next, maybe 3 to 5 years.
Central banks are set for a fourth straight year of heavy gold buying, with around 1,000 metric tons expected in 2025 as they shift away from dollar assets amid U.S. policy and geopolitical risks. In Q2 2025 alone, they bought 166 tons, 41% above normal levels, showing the urgency of this move. A World Gold Council survey found 95% of reserve managers expect gold holdings to rise in the next year, with 43% planning to add more, while many see the dollar's role declining over the next 5 years in favor of gold, the euro, and the yuan. Peter Schiff is a well-known economist, investor, and financial commentator, highlights that gold miners have surged over 50%, far outpacing bullion's 25% gain, with ETFs like GDX and GDXJ still trading at low valuations despite strong earnings growth. A Reuters poll sees gold averaging $3,220 in 2025 and $3,400 in 2026. Silver is up 32% this year, nearing $40, its highest in 14 years. He mentions that the S&P may be up about 10% this year, but with the dollar down the same amount, international investors see no real gains in U.S. stocks. In contrast, this performance gap signals a shift of capital away from the U.S., as both foreign and American investors redirect money abroad. Gold and silver mining stocks have been standout performers, up nearly 80% and on pace to possibly double this year, outperforming tech, crypto, and every other sector, yet largely ignored by mainstream media. Looking ahead, while developed markets like Europe and Asia have led in 2025, emerging markets remain undervalued and could be the big story of 2026. As we present clips from the video, please like this video, subscribe to our channel, and turn on the notification bell to stay instantly notified every time we upload a new video. Thanks for the support, and enjoy the video.
Well, look, the inflation is going to erode away most of the investment returns. Yeah, the S&P 500 is up 1.5% today, but the dollar's down 1%. So, it's really only 0.5% if you measure it in other currencies, and that's how investors around the world are looking at it. But meanwhile, foreign stocks are doing a lot better. Look at gold stocks, which, gold stocks are up another 2% on the day, but they're up 77% year to date. That's the GDX and GDXJ. So this is indicative of, the Fed being too loose. And, gold is up today, but it's still, below 3,400. Silver is now back above $39. But I think silver is getting ready to blow through 40. And I think gold's getting ready to blow through 3,500. Well, the economy is not booming, and nor is it going to boom at all during the Trump years. But in order to cure the problems that he inherited and that he contributed to during the 4 years he was president, right? He doesn't come to this thing with clean hands. But in order to fix the problems, we actually need a bust, right? We need the bust before we can have the boom. Trump wants to skip the bust and go right to the boom, which you can't do. All you can have is a bubble. So rather than have a legitimate economic boom, Trump just wants to inflate another bubble so he can pretend that the economy is booming, even though we're just blowing air into a bubble.
Yeah. And so you mentioned a bust. How bad could this bust look? Like how bad could it be?
Horrific. I mean, much worse than 2008. I mean, we have a huge debt bubble, and when it pops, there's a lot of disaster in its wake. I mean, there's going to be a lot of defaults, a lot of bankruptcies, a lot of failures. Look, stocks are going to crash, bonds are going to crash, real estate's going to crash. Look, a lot of bad, painful things have to happen to fix this problem. That's why the problem's not going to get fixed, because the politicians don't have any stomach for that pain, because it might mean that they don't get reelected. And of course, that's the only pain they care about is their own pain. And so they're going to kick the can down the road with another sugar high. And the Fed is now cooperating, cutting rates. By next year, they'll be in QE mode. Yeah, well, I think the S&P is maybe up around 10% this year, which is about how much the dollar is down. So if you're an international investor, you're looking at no return on U.S. stocks. Meanwhile, I look at my mutual funds. I have 5 mutual funds. One of my mutual funds is called the Euro-Pacific International Dividend Payers Fund. And we buy dividend-paying stocks outside the United States. So, higher dividend-paying stocks. So typically, these are more conservative type stocks. So they're not growth-oriented. We're buying them because they pay good dividends. Well, that fund, year to date, is almost up 40% now. 40%. Now, yeah, about 10% of that is foreign exchange related. But still, that is, a huge performance gap. I mean, basically, we're making 4 times the money investing in foreign stocks as we would be investing in the S&P. And that is a big signal to capital allocators around the world to jump on board this train. And so I think you're going to see a lot of money leaving the U.S. markets. Money that has been sucked into the U.S. markets for the past 10, 12 years is now going to get sucked out. And that means foreigners who have U.S. investments are going to sell their U.S. investments and bring their money home. But then Americans are going to sell their U.S. investments and send their money abroad. And so that's what's really going to be helping. I mean, my asset management company, Euro Pacific Asset Management, because that's what we specialize in. And again, gold stocks are up now close to 80% on the year, 77% for the GDX, GDXJ. This is the best year on pace that I can remember. I mean, there may have been a better year in the early 1970s, mid 1970s, but this, I think, is the biggest year, single calendar year that I can remember on pace. Because I think we could finish the year where the GDX and GDXJ, these are indexes, double in value, 100% gain in a single year. And gold stocks year to date are the best performing sector, gold and silver mining stocks, in the U.S. stock market. They're beating tech, right? They're beating crypto. They're beating whatever. Like whatever you think is the best, it's not. It's gold and silver mining stocks. And they're getting no coverage. If you watch the mainstream financial media, you'd have no clue that these stocks were doing so well. We've been way overweight Europe. And we have investments in Southeast Asia, including Japan. And we have some money in South America and in Canada. But I think we're going to probably be allocating a little bit more into the emerging markets. We have an emerging market fund that concentrates, and the emerging market fund is my least performing fund. Year to date, it's up, in the low 20s, which is still beating the U.S. by double, more than double. But the emerging markets haven't done as well this year as the developed markets. I think that may change in 2026. So I think we're probably going to allocate a little bit more into the EM for next year, because I think that's going to be a big 2026 story, is going to be the outperformance of emerging markets, because they're still really, really cheap compared to developed markets, and even cheaper compared to the U.S. market. Well, I think silver's looking pretty strong. We're just around $39. There's obviously some resistance up there, but if we can break through it, we're not quite at a 52-week high today. We didn't quite make the highs, but we'll see what happens next week. I know that these metals are basing, but silver is very cheap. And so I've been a real promoter recently, last 6 months in particular, even before, when it was 100 to 1, when silver was, when you could get 100 ounces of silver for 1 ounce of gold. And, it's not quite that cheap anymore, but it's still historically cheap. So I really like silver.
U.S. assets currently dominate global portfolios, accounting for nearly half of the investable market. However, rising concerns over U.S. weakening dollar returns are prompting investors, particularly in Europe, Japan, Sweden, and Australia, to explore alternatives like gold, Chinese tech, and emerging markets. Risk hedging via currency strategies is gaining traction as the dollar's depreciation erodes dollar-denominated returns. Peter reveals that China still offers plenty of cheap stocks, and with growing weight in emerging market funds, it's positioned to come out of the global trade war stronger, forming deeper ties with Russia, India, Africa, and even Latin America, while U.S. influence weakens. Meanwhile, U.S. tariffs, like the 50% duty on Indian goods, ultimately hurt American consumers and strain foreign partnerships. Commodities are set for a major boom as inflation rises and the dollar weakens. Energy, oil, natural gas, and agriculture all look cheap now, but demand will surge, especially from emerging markets that benefit from a weaker dollar. Instead of exporting to the U.S., these nations will increasingly produce and consume goods domestically, driving up demand for energy and resources. While this supports global growth, it also means higher commodity prices for Americans, many of whom will be priced out due to the declining dollar.
And so
I think there's still a lot of cheap stocks in China. We have some Chinese exposure in our funds, and especially in our emerging market fund where we're overweight China. But yeah, I think that China is going to come out of this, global trade war as the winner. I think that they're going to strengthen their trading relationships with the rest of the world. They're going to form better alliances with Russia, with India. This is going to be to the detriment of the U.S. And I think they're going to have stronger relationships in Africa, and maybe even in our own back door in South America. You might see that the Chinese gaining additional inroads in Latin America, because they're not going to be trading as much with the United States. It's not just that we shot ourselves in the foot. We're shooting ourselves in the head. Put 50% tariffs on India, 50%. Now, again, the tariffs aren't on India. They're on Americans who buy Indian goods. But it still is a problem for Indian companies that wanted to sell American goods, because now their goods are 50% more expensive if the Americans want to buy them. Yeah, well, first of all, if countries stop buying oil from Russia, it's just going to make oil more expensive, because if they have to buy it someplace else, you're just going to shift the demand, and we're going to end up paying higher prices. Ultimately, Russia is going to sell the oil anyway. It's going to get it out of the country. So it doesn't make any sense to put those sanctions on. And all it does is piss off people. Like it gives people another reason to get out of the dollar and get out of U.S. treasuries. Countries don't like being sanctioned. They don't like being pushed around. We wouldn't like it either if some other country was doing it to us. America benefited from other countries using our currency. We got the seigniorage gain. We got artificially low interest rates too, and we got lower consumer prices. But we're pushing all that away. We're, biting the hands that have been feeding us. So it's generally not a good idea to do that. And they also, need to hedge against Bitcoin if they have some of that. That's the stupidity too, because a lot of people in America, instead of buying gold the way they're buying it in India or China, they've been buying fool's gold, aka Bitcoin. And that's been a problem because when the Bitcoin bubble pops, a lot of these people who thought they were buying something like gold, they're going to find out that they weren't. So that's unfortunate because Americans don't own enough gold, either because they own Bitcoin or they own nothing. But owning Bitcoin is basically like owning nothing because that's all you got when you own Bitcoin is nothing. I think energy is cheap, natural gas, oil is cheap, agricultural commodities. I'm bullish pretty much on the whole complex of commodities. They're all going to be bid higher with all this inflation. And especially, as the dollar really tanks, if emerging markets are a main beneficiary of a weaker dollar, then they're going to consume a lot more commodities because, they're going to start consuming more of their own production. Instead of exporting stuff to America, they're going to build stuff and keep it. But I think there's going to be a lot more energy because they're going to produce a lot of things that are more energy and resource intensive when they're no longer just exporting trinkets to America. They're producing goods for their own consumers. So, we could see a real boom in commodities. And of course, this means that commodities are going to be a lot more expensive for Americans too. Just a lot of Americans won't be able to afford to buy them. They'll be priced out of the market.
Central banks record gold buying, weakening U.S. dollar returns, and the outperformance of foreign equities and commodities all point toward a structural shift in global capital flows. Gold and silver miners, alongside emerging markets, are increasingly attracting attention as U.S. assets lose appeal. With inflation, tariffs, and geopolitical realignments reshaping trade and reserve strategies, the next few years could mark a turning point where hard assets and non-U.S. markets take the lead. Could central bank demand alone be enough to push gold toward the $10,000 target? How will the shift of capital into emerging markets and commodities affect long-term U.S. economic influence? Share your thoughts in the comments below. We'd love to hear your perspective. Don't forget to subscribe for future updates, and if you found this content valuable, a thumbs up would be greatly appreciated. Thanks for being part of this journey with us.
Silver is going to fail to deliver. In my eyes, that's within the next few delivery periods. So I think before year end, you're going to see the silver market break. That will immediately spill over to gold. Clearly, China has way, way more gold than they say they have. I think probably Russia too. And just go back to the old saying, he who has the gold makes the rules. And that's what they're preparing for. They're preparing for the dollar/bonds, treasury bonds to implode.
I mean, so much is going on under the radar here. And that's probably because a lot of, when you think about the gold that's flowing into China, gold and silver flowing into China, it goes through 42 customs districts, which have 680 individual customs offices. I mean, there's so much fiddle room here. It's unbelievable.
Given that failure to deliver is expected to occur during the next few delivery cycles, probably before year-end, the silver market appears to be on the verge of collapsing. The shock would swiftly leak into gold if that were to occur. As the USD and US Treasury bonds teeter on the verge of collapse, China and Russia are likely holding significantly more gold behind the scenes than they acknowledge. While central banks currently hold almost 36,000 tons of gold, making it the second largest reserve asset after the dollar, and, in some ways, surpassing the euro, China is relaxing gold trade regulations to facilitate physical movements. Gold has reached fresh highs due to geopolitical threats, record central bank purchases, and waning dollar outlooks, and a WGC survey indicates that the majority of central banks want to boost gold holdings while cutting dollar exposure. Bill Holter, a well-known precious metals analyst and commentator, with Andrew Maguire, a veteran precious metals trader, highlights that gold and silver are seen as the ultimate hedge because, unlike paper assets, they can't go bankrupt. Recent reports show gold and silver prices are rising due to heightened geopolitical tensions, weak dollar expectations, and inflation concerns. Silver has lagged gold somewhat, but many commentators believe the gap, gold-silver ratio, indicates silver is undervalued. Silver, in particular, looks to be breaking out as China tightens its grip on the physical market, leveraging that position to influence paper trading. For years, nations like Russia and China quietly accumulated metals to avoid direct confrontation, wary of U.S. military power that historically enforced dollar dominance, examples being Saddam Hussein and Gaddafi, both eliminated after pushing for gold-backed alternatives. Dalio warned the U.S. economy is showing signs of a financial heart attack, driven by rising debt costs, citing its history of rising in crises and protecting against currency devaluation. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
Gold and silver, and the reason being gold nor silver can bankrupt. They are money themselves. They cannot bankrupt in a world that is bankrupting.
Absolutely. And I think if we can revert back to silver for a minute, because what we're seeing here is a huge, long-awaited breakout. Obviously, we all know that China has been in the driver's seat for a long time, and they've been playing the arbitrage trade and, being in control of the physical side of the market. They could arbitrage the paper side. But essentially, what we're hearing is, hey, gloves are off now. And especially after Trump's most recent BRICS attack on the BRICS, like clearly putting the BRICS in the crosshairs with tariffs. And then most recently, some very odd statements that he made after the SCO meeting.
Your comment, the gloves are off. I think that's up until this point. I mean, it would be extremely easy to break the Western financial system with $5 or $10 billion. I mean, if you went into COMEX and LBMA and said, "Here's $10 billion, I want metal," it'd be over. There's no way to deliver that kind of metal short term. So it would break the markets. In the past, I want to say that Russia, China, the rest of the world were being polite because they didn't want bombs raining down on them. One of the big things, the reason the dollar has been the reserve currency for so long is the U.S. military. Basically, we forced the world with threat of the U.S. military. If you don't use dollars, I mean, look at Saddam Hussein. Look at Gaddafi. They both talked about, 15, 20 years ago about doing a gold-backed currency. And what happened? They were killed. In the past, countries have seen, those two examples, Gaddafi and Saddam Hussein. They saw those examples and said, well, yeah, we'll just buy it quietly. And now that the war of words is on, it would not surprise me to see either a country or countries together step up. And the Achilles heel to the Western system is the fractional reserve nature of the entire system. But the way to expose that is just create a failure to deliver in either silver or gold, and it'll be both within 24 hours. If either goes, the other's going to go within virtually immediately. So they're at the point now, like you said, the gloves are off, and money is just flowing into, whether it be the physical metal itself or even the leveraged contracts in the West. You're seeing foreign nations buy those.
And I think most recently, and I know we're recording this on the 3rd of September, so it's not really a time-sensitive thing we're talking about here, but essentially what just happened, and I don't think this is clearly not going to change, is that it's quite clear from Trump's comments that the SCO meeting between these major hubs that you're talking about, and military powers as well, really ruffled the White House's feathers here, and they're not handling it very well, because basically, I guess really, I mean, maybe I'm naive to think, wouldn't it be better to have a multipolar world where you take all the barriers down? But I guess US dollar hegemony is the problem here, is it?
Well, that's the problem that the rest of the world sees. The rest of the world wants to get out from under Uncle Sam's boot, if you will, by using dollars. They don't want to use dollars, and they'd prefer not to be in the SWIFT system. I mean, ask Vladimir Putin. The U.S., the West, stole 300 billion plus of U.S. treasuries going back to, 2023, October 2023.
According to Bill Holter, cryptocurrency was created as a diversion from gold and silver, which are the real alternatives to the dollar. Since silver was designated a key mineral in the United States, its significance has increased, potentially limiting world supplies and retaining domestic production. Deficits are growing as Mexico's output declines and industrial demand for electronics, EVs, and solar rises. Silver may also be withheld by nations until prices significantly increase. By 2026, analysts predict prices to reach between $40 and $52.50 per oz. However, since no fiat could purchase gold and silver in the event of a currency collapse, they might become invaluable. Let's shift our attention towards the interview.
But I believe that the crypto market was created as a pressure relief valve from gold and silver, because they are viewed as an alternative, a dollar/currency alternative.
But silver's got my attention at the moment, and because you and I always have talked about silver. You've been so far ahead of the curve on silver, and I think it's now being by the US now suddenly naming it as a critical mineral. To me, that would mean that they're caught in a rock and a hard place here, because that means that US mined silver, that they probably start banning the sale of it. It has to be bought internally, perhaps. I don't know. What's your thoughts? Because to me, why would you allow a critical mineral to be sold?
Right. Well, I mean, look at it this way. Naming it as a strategic mineral or strategic metal automatically creates the demand of whatever the government's going to buy. And it automatically reduces the supply available to the market, because that supply is being bought up by the government. So you've already got a disastrous supply-demand equation. They just poured gasoline on that fire.
Yeah, and of course, what you essentially were saying here is that every other central bank, every other sovereign, everyone else is going to say, well, I'm not selling my silver at this price. I want a much higher price, and I don't quite know what that is yet.
The much higher price, I made the comment before we started recording, be careful what you wish for.
Yes, yes.
When we go through $50, and that's if markets stay open. I mean, there could be a failure to deliver, this month. I mean, who knows? But once we get through $50, you've got people talking $100, $200, $600 silver. There's really, in today's world, there is no way to project a number that gold or silver can go to. And I mean, the reason being, the parameters are zero and infinity. And the reason infinity is a parameter is because if a currency goes to zero, then it is priced at infinity in that currency. In other words, no amount of currency can buy an ounce of gold. That currency won't be accepted. And that's where we're headed on a global basis. I mean, if you think that the US dollar can collapse, crack up, and the system remain running, that's not going to happen. It can't happen.
Could the long-awaited decoupling of paper and physical prices be triggered by a real failure to supply silver on COMEX? How long before gold officially threatens the dollar's position as the primary reserve asset if central banks continue to reduce their exposure to the dollar? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.